Hello and welcome back to Death and Taxes, your weekly live stream podcast from the Australian Taxpayers Alliance. I am one half of your hosting duo, John Humphreys, and joined, as always, by Gene Tunney. Gene, how you doing?
Going very well, John. It's been a big week. Lots happening. So yes, going well. All things considered. How about you?
Top of the world, Gene. Another beautiful day in paradise. You know my answer by now. We did have.
I know, it's all relative. Yes, exactly.
Well, this introduction has become my way of just keeping people updated with my farming LARP. We lost a sheep and a duck and a goose, all in 2 days. So I'm going through the ups and downs of farming, and then had to kill a stray rooster, which I was supposed to kill. And geez, I am not good at it. And I come out here thinking I'm going to be a man on the land, and then when it comes time to swing the axe, it took me like 5 minutes to finding excuses not to do it before I finally did it. So, but anyway, enough about my fake farming career. We have a good episode for you today. We've got a couple of big things to talk about. We're going to have Gene's wrap up, of course, which this is the reason you come here and tune in. I know it. Dear audience, but part of that's going to be the latest inflation data and interest rates and all of that good stuff about the fake discipline of macroeconomics. We're going to have a guest.
We'll have to talk about that later, John. I've already got something to disagree with you on, but we could go. Please proceed.
I'm happy to unpack that one. We'll do that. So we have a guest coming up today, a new guest for the show. It's Derek Francis, who has been making some waves. Derek and his brother have been making some waves, uncovering a new problem with the government's tax reform package, a problem that looks like it was unanticipated and could be a real mess for their plans. So we're going to find out what that issue is, and work out, is there a solution? Well, we'll see. We'll see when that comes up. And I'm going to be talking about the various budgets. We've finished budget season. Every jurisdiction in Australia has done their budget. What is the good? What's the bad? What's the ugly? I've actually gone through and given them a rating. And as soon as Gene saw the rating, he already disagreed. So we're going to be able to unpack and have a few good arguments on that front as well. I should say, firstly, I rated them all an F to start with, but then I had to rate them on a curve. Otherwise, there'll be no fun. But we'll get to that when we get to that. So some housekeeping stuff. This is being simulcast on YouTube, Facebook, X, and on Gene's LinkedIn as well. So wherever you are, please go and find us on all of those places. Give us a like, give us a follow, and please share this episode. If you share this around the social medias, the algorithm learns this is the sort of material people need to see, and this is the material people need to see. So do us a favor, give it a like, give it a share. It really does help. It's the Australian Taxpayers Alliance that puts this show on for you, taxpayers.org.au, and on Substack, Oz Taxpayers, AUS taxpayers.substack.com. Go there, check out what we're up to. If you have the money, please consider becoming a financial member. But we do most of our stuff in front of the paywall because these are important conversations and people need to see them. With all of that out of the way, I'm going to invite Derek Francis to join us. Derek is an economist and an investor. He was formerly the chief economist with the New South Wales PBO portfolio, the Parliamentary Budget Office, trying to keep the politicians honest. It's a difficult job. Not sure how anyone could succeed at it. Private hedge fund manager, previously at the ACCC. I might forgive him for that. And also previously a director for UBS for several years. Did I get that right, Derek?
You certainly did.
All right, wonderful. I had some notes. I was cheating a little bit. But thank you for joining us. So as the regulars would know, I normally start with this little spray. If you're a sane person, you're not following the economic news that closely every day because you probably have a life. And congratulations for you. Unfortunately, we don't. So we go through the data. Gene has a wrap up so that you can ignore the economics for 7 days of the week. Come here and in the next 10 minutes, learn everything you need to know. So, Gene, what do we need to know?
Oh, very good. Thanks, John. And g'day, Derek. Good to have you on the show. Some big news yesterday. I think we were quite shocked by the new inflation figures that came out. Actually, I think I may have the wrong slide deck here. that should be the. No, that must be right. Yeah, essentially, we've got. No, that's the wrong inflation chart I put up. Okay, ignore that chart. What happened was the headline rate fell down to 4%, due to partly due to the petrol prices coming down, and that this is something that Jim Chalmers was very excited about, and made posted on. However, the problem was that the trend inflation rate has now gone up to around 3.6, if I remember correctly, and this is of great concern and just shows that underlying inflationary pressure within the economy. And what it means is that the potential for a rate rise in the next RBA meeting in August is a very real possibility. It's increasingly looking like, John, we've talked about it many times. The RBA really has just not tightened enough. It didn't lift rates enough and then started cutting them too soon. So yeah, we've got this ongoing problem with inflation. So shame I don't have the right chart, but the point is that trend inflation's heading in the wrong direction. Headlines coming down because fuel prices have come down, but that the data that was related to the excise cut that the federal government implemented, which is being extended for another month at half of the discount. So that is some welcome. That's some welcome news from the federal government for motorists. But as Derek will be explaining tonight, there's some other unwelcome news from the federal government that we'll be talking about. So that's the inflation story. The labour market data came out today. We're not really seeing the slowdown in the economy yet, or a substantial slowdown in the unemployment rate data. The unemployment rate remains low, and in fact, in seasonally adjusted terms, we had it fall down to 4.4% from 4.5% in May. So still no strong downturn in the economy. And I mean, we've still got unemployment at a rate that is, compared with what we thought it was, what the natural rate of unemployment was 20 years ago. I mean, we would have been happy if it got down to 5%, and now it's it's staying below that. It's rather extraordinary. I think, John, you made the point before that it could be related to the real wage declines that we've had due to wages not keeping up with inflation. So that could be part of the story that I think we've talked about that before. But otherwise, actually still a reasonable result, still a good result for the labour market. No sign of that downturn, that strong downturn yet. But that, again, from an inflation point of view, is bad news for the RBA, because they'd probably want to see unemployment going higher to help in the fight against inflation. And finally, the other bit of news is that Bitcoin went below 60,000 USD, and that is related to the expectation that we'll have rising interest rates in the US because of the inflation figures that we saw a couple of weeks ago that I covered on the show, that US inflation is looks like it could be accelerating. So that's the main news I want to cover. I think we've got that ongoing issue with inflation in Australia, and partly that is due to all of the big spending governments around the country, not just the Commonwealth, but as we saw this week, the state governments too. We saw that in two of the budgets that came out this week from New South Wales and Queensland, which no doubt we shall be talking about. Okay, John, that's all I've got for the roundup this week. Keen to hear your thoughts.
Now, I was half distracted at the end here. That Bitcoin number, so gold has also been going down. What explains this? People rallying away from hedges?
Well, Derek, we've got someone who's in the markets here with Derek. He might have some insight into that. But the way they described it in the Financial Times it's related to the expectations around interest rates. Do you have any insights, Derek?
I can tell you some long run stuff on gold, not short term. Look, I just did a regression with gold per capita as a percentage of wealth, and I went back to 1500. And you know how gold's recently gone from 2000 to 4000? It turns out that as a percentage of our wealth, the people holding it now, it's about 3/5 of what it was back in 1500, back 600 years ago. So if you actually believe the India-China dynamic, that they're using it as a store of wealth for jewelry, chains and everything, gold actually I'd be fairly bullish on long term, because as a store of wealth, as I said, it's gone down percentage-wise versus 600 years ago. And so although it's gone up to 2,000 to 4,000, they have to go up to 6,000 or 7,000 to get back to that as a percentage of our wealth. I don't know if that's interesting.
Well, it's always good to have as a hedge against the world going insane anyway. So fallback plan for those of us who don't trust the status quo. I think a better fallback plan than Bitcoin, but we could, at some stage we should get a Bitcoiner and a golder on here, Gene, and have them just sort of fight. Because that could be a fun debate.
Yeah, I think so. Yeah, absolutely. I like that idea.
Where do you fall on that, Gene? If what is the future of money once fiat falls over? Is it back to gold or forward to Bitcoin?
No, I don't think it's neither. I don't think it's either. I think there'll always be a fiat currency of some kind. I think we'll have. I mean, outside of a situation of anarchy, I mean, there'll be some authority that imposes itself, and having a fiat currency seems to be the natural order of things nowadays, and there are some efficiency benefits of it. The challenge is, of course, managing the money supply so that you can prevent inflation. But I can't see.
Accuse you of an intertemporal proximity bias. Proximity.
True. Yeah, I agree. I acknowledge that.
We've gone through various stages of fiat currency ascendancy. The Yuan dynasty was doing great with fiat currency until it wasn't. A few other places in history were doing great with fiat currency until they weren't. And the long-term track of, if we're studying history in the long term, not just since bloody Nixon took America off the gold standard, because that's relatively short-term in the big swings of history. And on the big swings of history, the idiom, I don't know how true it is, maybe this will buck the trend, but that fiat currency, all the currencies end up reverting to their natural value, and fiat currency's natural value is toilet paper. So it's worked for 50 years. But it wasn't the great quote where someone was asked in the 20th century what they thought of the French Revolution, and they said, "Oh, it's too early to tell." I think it might be too early to tell.
That would have been. Was that Deng Xiaoping?
No, that might have been. Yes.
Yeah. Look, I take your point, but didn't Ronald Reagan look into gold in the early '80s, and he had Milton Friedman and Alan Greenspan look at it, and both of them agreed that it wouldn't make any sense for the US to go back onto the gold standard. I mean, like once upon a time, Greenspan, we should acknowledge, died this week, didn't he? The maestro. I mean, someone who was such a pivotal figure in central banking, and I mean, a great economist before that. Well, it's certainly in terms of being a market economist. However, his reputation will forever be blemished by the financial crisis. Nonetheless, he was a pivotal figure. So, but yes, as both of those people, both of those economists, they didn't support going back to the gold standard.
That's okay. I'm happy to argue with everyone. I guess time will tell. Time will tell if we live long enough.
Yeah. Look, could I just pick up on? Yeah. Sorry, just want to, on the Bitcoin while we're on it. I mean, one of the other hypotheses is that it's people switching back into AI stocks. I mean, just enthusiasm around them. So people are getting off the Bitcoin. I mean, we've possibly got a bubble in AI stocks. And then because of, people are concerned about, well, what if interest rates go up again? That might adversely impact the economy. And so there's all sorts of potential explanations. But certainly, we're seeing the Bitcoin go below 60,000. I mean, I don't have a problem with that. I'm very skeptical about the value of Bitcoin myself. So but John, go ahead. You're going to ask a question.
I was going to say, onto the other stuff you went through. You mentioned the unemployment rate, and I think you mentioned the Nauru. Did you say that?
I didn't say Nauru. I said the natural rate of unemployment. It was in the intergenerational report. Didn't we set it at 5%?
I don't know what natural rate of unemployment means, other than their best guess, which is normally informed by whatever was the average for the last couple of years. Again, an intertemporal proximity bias. I don't think there is a natural rate of unemployment. Normally they refer to that as the Nauru, the non-accelerating inflation rate of unemployment, which is of course based off the Phillips curve, the idea that there's a trade-off between your unemployment and your inflation. Go ahead.
John, just quickly, do you also do any sort of stock tips at all related to gold, or do you want to hear my best tip if you are bullish gold? Or
yeah,
I don't do stock tips. I should quickly preface this with this is not investment advice. Do not sue us later, no matter what happens.
If you took investment advice off live stream.
Don't take investment advice, and I've got no idea of what I'm doing. But look, personally, the one I'm taking a little bit on is called Brightstar Resources. The stock code's BTR. It's a WA gold miner. Right at the moment on spot gold and its current share price, it's on a PE of about 2 times. And it's discovering a new iron ore province around the Sandstone royalty area that could make it the next big. So all I'm saying is if you are bullish gold, just have a look and do a deep dive on Brightstar Resources. I think I personally wouldn't put too much of your portfolio in it. It's the sort of something like put 2 or 3% in it. It's a specky punt, but that's my gold play for those that are bullish on it.
Oh, this could be a new sideline we end up doing here. We call it not investment advice from Death and Taxes. I mean, my very unhelpful advice to most people is to say that anyone who knows how the markets are going to go won't tell you. Anyone who tells you doesn't know. As a general rule, you make more money by not telling other people if you've got inside information. So, look, the truth is, I just don't know.
Just on the natural rate of unemployment, you said you don't know what it is, but you were once the organizer of the Friedman Conference, and Friedman, of course, gave a very famous definition of the natural rate of unemployment in his presidential address to the American Economic Association, didn't he?
You have me at a disadvantage.
Where he said that the natural rate of unemployment is that rate of unemployment which would be ground out by the Volrasian market clearing mechanism. So it's essentially really like if you essentially let free markets reign and operate, then that's what you would get.
Well, that would just be that's just frictional unemployment. Then that's just the time it takes for people to drop out of one job and get another. And so, but I don't think that's what anyone means by natural rate of unemployment now. They mean Nauru or something like it, which I think is bunk. It's Nauru keeps moving. It keeps just following whatever the unemployment rate is with like a 1 or 2 year delay, as all the modelers realize their last made up number was wrong. And it keeps being wrong. So they make up a new number that now looks right because they base the new number off reality. That's not a good way to make a prediction in my books. It's but this goes back to the idea that macroeconomics doesn't exist. Isn't that right, Derek?
Look, I personally think most macroeconomics is voodoo. And if you're going to listen to macroeconomists, you may as well listen to an astrologer in terms of advice on where the economy's heading. But that's just my opinion.
Well, I must say the problem is they use time series data, and there's all that inertia in the time series data. And when you estimate a time series model, it all just gets driven by the recent, what is the average over history, as you were saying, John. And so back in the 90s, people were estimating the Nauru at 6% or 6.5% or even 7%. So it's so you're right in that sense.
And just to round out the things you brought up there, Gene, it was inflation and interest rates. Inflation 3.6. I know you got the wrong slide there. You can quickly in the background when Derek's talking, bring the right one back up later.
Yeah,
in case
let
you
me
wanted
see
to
what
show
I can do.
But here's the comment from RW here. This is in response to you, Derek. Astrology actually has more science than macroeconomics.
My sort of person.
I think it's a little unfair just on that. Look, macroeconomics, it depends what you mean by macroeconomics. There is such a thing as money and monetary illusion and monetary shocks. So that's macroeconomics. There is such a thing as economic development and economic growth and trying to work out what causes economic growth. That's normally bundled into macroeconomics. So in my opinion, economics shouldn't be split into micro and macro. Micro just is economics. But two things that economists, the two things that economists look at is how money distorts other markets and how economic growth comes about. And so I wouldn't draw a circle around them and call them macro. I just say those are two interesting topics in and of themselves.
Yeah, look, I 100% agree. If you approach any macroeconomic problem using the microeconomic framework, you will do a lot better.
We got a bit of love here for all economists here coming from Anna. And I saw Anna was contributing quite a lot of comments before we started. So I thought I got to give her at least one comment. But we love you too, Anna. Great work. So with that 3.6% inflation rate running, I noticed as well, by the way, the budget's predicting 5% for the next financial year nationwide, which is an interesting prediction. That would say to me, you raise interest rates, of course, but Gene, as you'd know, we've been encouraging the RBA to be a bit more hawkish than they have been for quite a while, and we blame them for not having for having cut rates too heavily, too quickly, and too much.
Yeah.
Back during the COVID insanity. But what is your take then, Gene? I know you're doing something in the background. Maybe Derek can take this one first if he wants. Whether they should have cut, in your opinion, should the RBA raised rates? Should the RBA have raised rates again, given the inflation data? What do you think, Derek?
There is an X factor here that a lot of people don't understand, and that's the federal budget. I would say if they'd done nothing in the federal budget, then they probably should have raised rates once more. But this federal budget, my view is it will crunch the economy. And I'm very confident it will crunch the economy. So if I was the RBA, I would wait 3 to 6 months for those full effects to begin playing out. And that's something that people just aren't taking into account. I'll go in it when I go into my speech, but even Labor doesn't realise just how badly it will crunch the economy.
Well, that seems like actually a really good place to segue, Gene. I don't know if you wanted to sneak in an opinion on the interest rate. Maybe we'll get you to segue your opinion back into it later.
I think they should have. I think there's a real problem with inflation in this economy. They haven't got rid of it, and like the inflation, because there's that lag between the impact of the cash rate change and the impact on the economy. They're well behind where they should be. So just really bad news for the Australian economy. But look, Derek makes a good point. I'll be interested in asking Derek what he sees the channels are. Obviously, there's the negative gearing and the CGT, so there'll be a wealth impact. I mean, you're obviously assuming a significant wealth impact and a cash flow impact for those for investors who would otherwise be negatively geared. So I think I finally got the right inflation chart. Yes, there it is. So there's the pickup in May, John, where we've got the trimmed mean and the weighted median both going up to 3.6, even though the headline's going down. And you look at that and it looks like it's starting to trend up, doesn't it? So that could start accelerating that trend rate up to around 4% or so. That should be of grave concern to the Reserve Bank.
Well, that light blue line there, that'll be driven by the government's rebate, the cutting of the petrol excise.
Exactly.
So you take that out because the blip up and the blip down, you can just put those aside. Those aren't structural problems. For structural problems, you want to be looking at that pink and blue line, or what G calls the magenta, isn't it?
Magenta.
And blue lines. And that does look like it's trending the wrong way. I was just quickly looking it up. looking at which goods and services are going up in price. You got only insignificant ones, again, as usual, food and housing. Of course, you don't need those. You could get by with just recreation. And alcohol, unfortunately, is also trending up. But this is not being driven by transport, which is the foreign war that we've been talking about a little bit in the past. So that's worrying signs underlying it all. Although Derek makes a very good point that maybe there is structural problems. Here's one suggestion. The structural problem is called Jim Chalmers. Perhaps that is right.
Yeah, look.
Right, so let's use this segue, Derek. So you made a very good point there. If people like Jean and I normally looked at this inflation data, we would be saying this is the time to bump those interest rates up because you've got to get inflation under control first. Priming money into the economy isn't the way to have growth. You need productivity for growth. Monetary policy is there to prevent us destroying our economy through monetary distortions. That would be our normal argument. And you made the very good counterpoint. Sure, that might be true in most times, but the government has just put a hand grenade under the economy, pulled the pin, and is walking away. What do you mean by that?
I mean a few things, but to put it quite simply, they have implemented the world's highest capital gains tax. Okay, now to be quite simple, the first question that Anthony Albanese was asked in question time this week is name one country that has a higher capital gains tax on real gains than Australia once you implement these changes. He spent 4 minutes flouncing around and couldn't answer the question. We reposted that video on X, and I welcomed anyone to nominate any country with a higher capital gains tax than Australia after these changes have been brought in, and no one has yet to name a single country that has a higher capital gains tax rate than us. They have effectively increased the capital gains tax by somewhere between about 50 and 70%. And to be clear, the people that this actually hurts the most, and I won't miss my shots here, is young people, poor self-funded retirees, people at home looking after children, and poor people. Now, the reason why is most of them don't own their own homes. The one hope they have of lifting themselves out of their poor situations is by saving more than they consume and then investing that money. Right at the moment, under the current tax settings, if they invest their money, they will basically pay virtually no capital gains tax at all. If they're on 0 to 18,000, they pay nothing. If they're on 18 to 30 to 45,000, they pay 16% if they've held it less than 1 year and 8% if they've held it for more than 1 year. Under this new capital gains tax regime, they will pay 50% on their capital gains, 50% tax. And it's a combination of the fact that you've got a minimum of 30%, but also there's a tax asymmetry that I'm going to talk about, which means what happens is they tax your winners, but they don't allow you to offset your losers. And I'm talking about in real terms, anything that doesn't beat inflation, they don't allow you to offset that against anything that does beat inflation. They allow you to offset what I call nominal losses. So if something goes down from 100 to 90, they'll let you offset the 10. But if it's 100 and inflation's gone up to 105 and it stays at 100, they don't let you offset that inflationary gain. What the Treasury model assumes, and it's a complete BS model, it's unrealistic, is they assume that an investor only ever invests in one share and that share always beats inflation, so you get the full benefits of indexation. Now, that's a completely unrealistic model. Anyone that's traded in a stock market or traded plenty of Bitcoins knows that on average, probably about 30 to 40% of your portfolio will not beat inflation. Now, as soon as 30 or 40% of your portfolio doesn't beat inflation, you no longer get the full benefits of indexation. You only get about 60% of the benefits of inflation going up. There's a long-run study in the US, and what it said, it analysed stock prices over 100 years, and it found in practice 60% of stocks don't actually go up in nominal terms. If we replicate that, and the reason why is economies are dynamic. You get some companies are absolute winners, and it's a winner takes all. The winners really win big, and the losers don't do anything. And so if I take the example, say, for example, in banking, if you'd owned the 4 banks over the last 20 years, CBA's been an absolute belter. It's beat inflation and it's done really well. The other 3 banks have underperformed inflation. If you put $2,500 into each of them or $10,000, all up, your gain is $1,200, but the tax you would pay under this new system is $1,800. They're taxing you at more than your real gain. And the reason why is because you're 3 underperformers that have underperformed inflation, they're not compensating you for. So under this new system, you're getting very high effective tax rates. They'll be somewhere between 55 to 70 or 80% of your real gain. After Albo couldn't answer where's the country with the higher tax rate, Chalmers tried to take over and he was sort of half laughing. And then he says, this is what he says in question time. He says, real gains is not an appropriate measure to compare. And he said, I'm going to talk to you about nominal gains instead. And he gave BS figures on nominal gains. The whole idea of moving to this real system with inflation hedging is we are supposed to be taxing real gains. But the model never taxes real gains unless you have this ridiculous assumption that you own one share that always beats inflation. As soon as you move away from that, the tax rate skyrockets up above your marginal tax rate, and typically it will be double your marginal tax rate. So whatever your marginal tax rate is, if it's 40%, double that, and that's the capital gains tax you're paying on. That's the capital gains tax on average you'll be paying in real terms on your investments in the stock market. So basically, I've said numerous times it makes the stock market in terms of direct vesting completely uninvestable. No one will play that game anymore because it's too asymmetric. Like if you win, they take 70% of it. If you lose, your losses, they're your fair weather friend in investment is what I say. The losses are 100% yours to keep. But the big winners that you have, they'll make sure they take a huge cut of it. So this crunches the economy. You can have a look anywhere. The other thing it does is anything that's high risk, high return, it differentially crunches that. So you could have a portfolio where you've got 10 stocks. Let's say one of them gives you the totality of your return. So let's say one's a 10 bagger and the others do nothing. You'll probably end up paying a tax rate of 120% all up. So mining explorers that are typically high risk, you get one that like goes 10, 20-fold and 9 that are duds, you'll pay more tax on that portfolio than what your total gain is typically. So the mining explorers, they've said, look, we raise from the retail punters. Our whole market model is dead. Biotech, they're saying their whole market model is dead from raising from retail punters. And the thing is, startups are saying this doesn't work for us. If it doesn't work for startups, it doesn't work for anyone taking risk. I say anyone investing in the stock market, a young person investing in the stock market is a startup. It's taking huge risks. Some of the investments will work, some won't. And the idea that they're your fair weather friend where they take 50% of the things that win and you get the losses to keep 100% yourself is absurd. Now, Treasury actually internally know about this mistake. This is the Commonwealth Treasury, but they haven't briefed Jim Chalmers as to the extent and size of it. So Jim Chalmers is in cuckoo land at the moment. The grapevine tells me in Treasury, he's sort of internally walking around high-fiving everyone and saying, oh, this is great, I want to do more tax reform. What he doesn't realise is with this so-called ambitious tax reform that he's done, he's directly killed. It's the death of direct share investing for 9 million, 10 million people that currently own shares directly. And I'll tell you the stupid and ridiculous thing about this is if you take those same shares and instead put them into an ETF or a managed fund, so you own exactly the same set of shares, all of a sudden you don't face that diversification penalty. You'll pay 50% more tax from owning the shares directly than owning the exact same shares in a one-unit structure. And the reason why is the one-unit structure basically smooths it all out and you get the average return across it. So what it means is anyone that's investing, they will have to be advised by a financial advisor. Don't invest in direct shares anymore. Just invest in one huge index fund, something like the Vanguard Index Fund or Vanguard International Fund. And it's the diversification penalty is just so huge. If you invest in one index fund and it beats inflation, you're fine. But as soon as you invest in 5 or 10 stocks, or even 5 or 10 managed funds, no matter what happens, you're getting what I call this diversification penalty. As soon as any of them underperform inflation, all of a sudden your marginal tax rate goes up above inflation and it rises the higher the percentage that underperform. Does that all make sense? I've tried to explain it as clearly and as possible.
That's great. Derek, can I ask? What can you talk about how you see the short term versus the long term? What you're talking about there, that sounds like it's more related to the long term consequences in terms of we're not going to have the investments in startups that we want as an economy, or a broad range of startups, not just the tech startups that they're giving special favors to. But the mining explorers.
I can talk to that. But look,
that's the long term. But sorry, what about the short term? Do you see the short term?
This is the thing about markets: is markets look through all of this. They think this has now been legislated. So the US, the WA mining industry, the mining explorers are saying our market is now dead. We can't raise money right now because we know come 2028. The punters that are taking the stocks are going to be exposed to this new regime. So, yes, we get a 1 year reprieve until it's implemented at July 27. But as soon as the stock that I've invested in that's high risk takes off, it's subject to the new. So markets look through that. They look through it instantaneously. So as soon as this new thing got implemented, if you talk to the WA mining industry, they all say the market for exploration and startups is now dead. The market for junior miners that are trying to build mines is dead. The market for any sort of fintech type startups, the market for biotechnology, they're all dead now. Okay, you can forget about raising money from retail shareholders. And Treasury is being exceptionally arrogant and exceptionally stupid. They're saying, we don't have to worry about this. Retail is only about 20% of the market. There'll be international investors and super funds that will come in to fill the void. It is complete BS. The essence of markets is it's based on local knowledge, people having local expertise. So in WA with the mining, they raise a whole lot of money from local retail punters because they think, I know this person, I sort of trust him. He's pretty good at finding stuff. I'll put some money with him. Same with biotech, same with fintech and everything. It's all based on local knowledge and people backing people that are winners. That's all dead now. Any risk-taking behaviour in investment is dead. So I sort of relate this. Some of you might know the movie Margin Call. Do you remember?
Yes, love that one. Jeremy Irons.
Exactly, Jeremy Irons. So this is the equivalent. This is the equivalent of the young guy after he puts the old guy's thing through his model and says, "Hang on, there's a mistake in the model. When I put this through, this all of a sudden crashes our whole firm. And if the markets were to drop by 20%, it's worth more than the market capitalisation of the whole firm." This is exactly the same thing. As soon as you put through this asymmetric treatment of risk and it runs through the whole economy, it ends up crashing the whole economy because junior explorers feed the BHPs and the Rios of 10 and 20 years down the track. The junior fintechs, they feed the next Canvas. And the small caps is dead as well for retail investors. And look, I'm not the only person that's generated these results. Anyone can go on X. I'm on X under Decker, but anyone can go on X and look at the results. A guy called David McMahon ran a regression of 50,000 different historical stock portfolios in Australia that typical investors will invest in. And he found on average the effective tax rate on real gains was 55%. Mm-hmm. Then there's another guy, Robin Dodds. He ran a regression analysis of all small caps in Australia over the last 20 years. If you'd been invested in the multi-combinations, the effective tax rate on capital gains goes up 77%. And then even the young guys are doing this. So there's submission 141 to the Senate inquiry. It's a young guy, and he said, look, I've run 20,000 stock portfolios based on historic prices. The capital gains tax rate goes up in real terms from 34% to 55%. So, and it's the asymmetry. It's the asymmetric treatment. The winners, they tax very heavily. Those that lose against inflation, they don't allow you to offset. And Jim Chalmers is in a parallel universe. When he talks about the tax rate being 21%, it is a dishonest lie. As I've said, it's based on a ridiculous model that assumes you only own one share, and that share always beats inflation. No investor that runs a diversified portfolio can actually ever do that. And even the Warren Buffetts of this world have a few losers. And typically an investor in their portfolio will typically have somewhere between about 35 to 60% of their stocks will
so
be
Derek,
losers. Yeah.
It's just occurred to me if Treasury, it sounds like, so Treasury didn't understand this issue, what they were programming into the tax, into the CGT with this asymmetry. Does that mean that this will end up raising much more revenue than they?
No.
It won't. Okay, tell me why.
Okay, so what happens is for wealthy people, this is fairly easy to avoid, and it'll just induce a huge. This is what John was talking about beforehand. You've got to model the behavioural effects. So I'll tell you, with me personally, at the moment, what I'll do is I'll just put any spare money. I've paid off the house. I'll put any spare money into my super fund and my wife's super fund, self-managed super funds, and I'll do that until that gets to 3 million each, and that places a tax rate of 15%.
Yeah.
Versus currently I'm paying 30 indirect, but I'd be paying 60 under the new system. So I'll do that first. And then when I tap that out, as soon as my children get to 18, I'm just putting the money in their self-managed super funds. So I've got 4 children. I'll be able to build them up each up to 3 million, paying 15 and 10 to 15%. So I'll do that. So wealthy people, easy to avoid. The people that, because they've got various devices they can use to avoid it. You're just going to super. If you've got surplus, if you've got your house paid off, just go into self-managed super and you avoid this very easily. So they've lost tax from those people. They haven't gained it. Then I agree with you, the young people, it's very, very difficult for them. The only way they can actually avoid this, and this is what I've said, is by going overseas. But there is a little bit of a trap. If you own current assets and you go overseas, you can elect not to pay capital gains, but you'll eventually, if and when you do sell them, you'll pay capital gains at the Australian rate on the assets you currently own. But if you're 20 and you haven't got any assets, just go overseas, go to Singapore, Hong Kong, New Zealand, you'll face zero capital gains tax rate. You will build wealth 2 to 3 times more quickly than you do in Australia under this new regime. So if you haven't got assets or you've got very little assets, you're much better off going overseas. And even if you've got some assets, you're still better off going overseas because any new assets are subject to your new countries. So what this tax will do is the best and brightest will figure this out. They'll go overseas, and the crunch to the economy is huge. They lose all the junior explorers. They lose all the direct share investing. And in terms of the stock market, the managed fund industry and the direct retail share advice industry, that's all dead as well. So the unemployment from this is huge. My own feel is this probably decreases the size of the economy by about 10%. So
how is this bad for managed funds? I thought managed funds would do well out of this because they would be like the safe haven of avoiding the CGT.
Yeah, it's a good question. The only managed fund that avoids this is the mega fund, so the index fund that offers one. But any managed fund that offers exotic strategies, you're subject to exactly the same diversification penalty. So if I'm a managed fund and I say I'm offering a mining strategy, I'm offering a commodity strategy, a gold strategy, and I want you to invest across 4 or 5, they're in trouble. If they offer one big fund, then yes, they'll do okay. But you'll get everyone triangulating to this one big fund. And then the problem is if you put all of your investments, so let me finish this. If you put all your investments in one big fund, you're subject to what I call the monopolisation problem. They'll say, we know you've got everything with us in this one fund. Your fee last year was 0.5%, but you know what your fee is this year? It's 5%. And you've got the choice. Your thing's gone up 20%. But if you liquidate it, you're going to incur huge capital gains tax. So you're beholden to them. So everything's going to gravitate to just 2 or 3 big mega funds. And the managed fund industry is in deep trouble under this as well, I think. Because there'll be 2 or 3 reputable ones that will say, I'm not going to raise the fees on you. But any fund, any managed fund that's offering 5 or 6 different strategies, that's dead now as well.
It seems to me, you said Treasury before made the claim that there would be, the workaround would be that people just go into, you said there's international investors, super funds, and I'd say that the big bank managed funds, it seems like the obvious place as well. And that probably will be where a lot of the money comes from, and probably will be where a lot of the people put their money, because it's, as you said, you're going to put it into the super. Other people will just say, well, look, if I'm getting screwed, if I'm making smart trades, I'll just put it into a managed fund and avoid that tax problem. And look, I think there's probably some truth to the claim they made that that's probably where things are going. But I think that's another red light. I mean, this seems to me like an exercise in the centralization of capital control in the hands of fewer and fewer people, which is one of my arguments against the, it's a bit of a segue, one of my arguments against the compulsory super system is it's funneling more and more capital control into fewer and fewer hands. And it seems like when they're doing that on steroids, this seems like a crony capitalist pitch to help the big end of town, another unholy alliance between big government and big business, while small business, small-time investors, normal people who don't have well-connected friends get screwed.
Well, so look who the treasurer's mentor is, former boss is.
Paul Keating. Look, it helps the industry super funds. It helps the industry super funds because there will be a flow into there, and it's very disappointing. Self-managed super is a big winner from this as well.
There's a post from RW here directly, I guess, preempting that comment. They'll be after the self-managed super funds next.
Yeah,
they'll find from this, what they'll find is the tax revenue that they're expecting actually probably is zero or goes backwards because there's so much behavioural change. So they'll have to look at the next industry to completely screw over, and self-managed super is probably the obvious thing to do to come after next. But in terms of economics, look, I've been in the economics policy game. I've worked for government, advising governments for 12 years. I've worked as a private investor and advising some of the brightest international funds for 8 to 9 years. This is the worst piece of economic policy that I've ever seen implemented by any government ever in the history of Australia. It's needlessly destructive, and it achieves nothing at all. And it hurts young people the most. Those that are trying to buy a house, it hurts them the most, because all of a sudden on whatever they're trying to save for a house, previously they were paying taxes of 5 or 10%. Now they pay taxes of 50% on that thing that they're trying to grow to make the house deposit. So if you had to design a policy to lock young people out of housing, this is it.
So if I may, I'm going to play devil's advocate here.
Go for it.
You didn't have a heads up for this, but look, everything you're saying makes sense to me. I think a 10% decline in the economy sounds maybe over
long term.
But the fundamental, the underlying problem you've mentioned seems certainly to be there, and it sounds like it's going to have a negative impact. So I'm with you that far. But devil's advocate, the system we're switching to is very similar to that existed during the 80s and 90s. And the 90s didn't see a wailing and gnashing of teeth and cats living with dogs and the world going mad. We seem to be able to live through the 90s effectively. Why couldn't we again?
Okay, so let me take you through this properly. The first thing is that we started in 85, and remember, everything pre-85 was grandfathered. So no one had assets that were going to be subject to it until they actually begin building. But the world has changed since then. Previously, retail investors, if they wanted to buy a share, they'd ring up their broker who'd execute the order 1 week later, and they'd buy maybe 1 or 2 shares a month. Nowadays, we have youngsters that are trading crypto on their mobile phones. Half of the people in the 25 to 34 year age bracket either have shares or crypto assets. That just didn't exist back in the 80s and 90s. And then you remember 90 to 93, 94, we had the worst recession ever. We had unemployment at 10 or 11%, and we had interest rates up at 16 or 17%. So anyone that says that's somehow some halcyon time that we should go back to, they need to actually do an examination of economics. So we had that huge recession, and yes, we began slowly recovering from that. But remember, we got to 95, 96, we had a brief recovery, and then the economy went to crap again. And that's how Howard got elected in 96. So we had huge gains in the early 80s. Keating did some good reforms, economic liberalisation, reducing tariffs, floating the dollar, the dividend imputation system. They were all good. But the capital gains tax thing, that was taking place in a market that was very immature. Retail was a very small proportion of the market, and retail didn't trade where any of the velocity of what it trades now. We didn't have the internet, and we didn't have mobile phones, so people couldn't trade in real time. You didn't have the day trader concept that you have now. So basically everyone's engaged with assets. Young people are especially engaged, and most people know long-term you get a much better return from shares and or digital currency assets than you do from bank deposits. So the young people are all putting their stuff into shares and or crypto, etc., and all of that. So it's a completely different economy. And it's like saying to me, Yeah, the car's been invented for 10 or 15 years, but by the way, we got on fairly well before when we just had the horse. Let's go back to just having a horse. It's the most ridiculous. It's the most ridiculous argument I've ever heard.
I like horses.
Well, I like horses as well, but don't ban the car.
No, I understand that.
It's insane.
In economic terms, there's been a degree of hysteresis where we've just things changed, and that people have locked in such a different approach to the markets.
Exactly.
That going back is going to require us to unwind a hell of a lot of stuff that's built into the economy, and building on that, the reality that it may have been that allowing people to more effectively engage in capital markets is one of the things that allowed us to do fairly well through the noughties. And if we want to unwind this policy, we might have to unwind that success.
But just building on that, they had a huge review into this capital gains tax system by John Ralph in 1998, and it concluded that the capital gains tax system was terrible because of this asymmetry. It treated risk poorly and it undermined risk-taking and innovation. That's why they moved to the new system, which is simple, and it taxes capital gains a lot less. The only person that actually is advocating for this return to the 1990s is Paul Keating, and he should be, in terms of his economics, he should be carted out in a box as soon as possible. The whole thing's a complete disaster.
Yeah. John, did you want to run through your proposal for CGT, which Graham Davis, I don't know if you know Graham at all, Derek, my former boss in Treasury, I mean, very smart guy, who essentially he proposed what John recommends with CGT in a Senate submission. I wonder if he got it off this show. Who knows? But John, did you want to go through that? Because I think your proposal is very interesting.
Well, it's not going to it's not going to fully fix what Derek's talking about. But Derek, to give you some background here, I mean, I'm happy to just go back to the 50% system. So I'm not dying the wool on this, but I've made the case that if they wanted to switch to cost-based indexation, the big problem in what they're doing, well, now there's a second big problem that you've outlined, but the big problem that I already had was that it shouldn't be indexed to CPI. It needs to be indexed to a much higher number than CPI for it to be able to make sense as a CGT system. So I've suggested in the hope of getting Labor to pay attention, I made a more modest suggestion of CPI plus 2 or 3%. And I think that would get you closer to a revenue neutral CGT system. And it would ensure that a lot of people making consistent normal returns actually have a capital gains tax cut out of this. It would be people who made short-term speculative, Uber returns in a short amount of time would, of course, see a higher capital gains tax under that proposal. But what's your thoughts on that?
John, look, someone who's very bright wrote into the Fin Review with a very similar proposal. He said use the risk-free bond rate, the 10-year government risk-free bond rate as the appropriate mark, which is currently at about 4.5 to 5%. So it's only the gains that are above that you should tax. I would be okay with that so long as there's also not the loss asymmetry. So they allow you to deduct losses against that as well. That would be a perfectly reasonable way to tax. But when you say you've raised a point, and that's an interesting point, I would say it's the whole point. What it means is that the actual effective tax rate rises by about 50% on what everyone thinks it is. So people that are assuming away this asymmetry point don't know what they're talking about. I don't mean to assume
it away. Yeah. I'm going to ask a question about how we can unscramble the egg in a second. But I mean, if you did... if you did the bond rate or your things, inflation 2.5%. Well, the bond rate probably wouldn't be enough The bond rate wouldn't be enough compensation to be able to compensate people for the impacts of the issue you've outlined. But if you did index to a high enough amount, there would still be winners and losers. There'd still be an asymmetry. There'd still be an unfairness for some people. But if you index to a high enough amount, you'd eventually be able to, as a whole, compensate an average number of people.
So dealing with the asymmetry is even more important than whatever the final rate is. And the reason why is you want people taking risky bets. The economy is uncertain, but I'll give you a scenario. If you've got someone that is taking 10 bets, on average, they'll get 11% return, but it's because one of them is going to be an absolute winner and the other 9 are going to be losers, versus someone taking one bet that returns 8%. You always want the person that's doing the first to be the person doing that in the economy, because that's the stuff that grows the economy. It's the risk-based bets that some of them come off, some of them don't. That leads to the innovation that actually improves living standards. My problem with a system that says, look, I'm going to tax you high on your winners and I'm not going to compensate you for losers, is it stops people taking good, what I call socially desirable, good risk-taking behaviour, because it isn't appropriately rewarded in an environment where we make all our decisions under uncertainty. So I can go and invest in 9 explorers. I've got a feeling 1 or 2 will come off, but I've got no idea which ones. If all of a sudden you're taking 50% of the 1 or 2 that come off and you're giving me 100% of the losses, it just doesn't work for me.
Yeah.
Do you understand the point I'm making, John?
Oh yeah, no.
You've got to reward risk taking in this, and it's a crucial thing. You've got to reward the people that are doing the next Canva, the people that are doing the next Atlassian. You've got to provide an appropriate risk, because for every one of them, there are 10,000 failures. And the model you're talking about, it's the equivalent of you saying, oh, look, the next Steve Smith or something, what we can do is when he's the next Steve Smith, we can take 90% of their earnings from them because we know they can't do anything else to play cricket. So let's take 90% of his earnings because we know he's still going to play cricket because he can't earn anything doing else. But you do that, you're sending a signal to every youngster that wants to play cricket. If you're actually successful, you won't be a superstar in terms of your wealth. You'll just be a peasant.
Well, these are problems just writ large across the idea of taxing risky behavior when we not want desirable risky behavior. I'd say, look, this isn't the point you were making, but I just this isn't touche. Maybe jumping off a cliff isn't the same thing. But look, this wasn't the point you were making, but I'll just get it into the record here. I see people talking a lot about how we want these risks of people creating a brand new thing.
Yes.
Sure, true. I think people underestimate the importance of encouraging people to take the risks of just opening another business that already has existed. I mean, that's how we've got a system that works through innovation and then imitation. Innovation has the breakthrough. Imitation creates the competitive pressures to get your price close to marginal cost, and then it creates the incentive to have the next lot of innovation. So people just opening a regular shop, they're still taking a risk, right? I mean, starting a business in your neighborhood, it might not be an innovative product. You might be selling eggs. That's not an innovative product. But no one had been selling it in your neighborhood before. There might not be a market. You could still go bust. You could still lose your money. I still want those people to take that risk and start that business. I just want to see a lot more people starting whatever businesses they can in their area. So, look, I know that wasn't your point. I'm just saying that.
No, that's my point exactly. I reckon that's my point exactly. It's the restaurant starting a new theme. The new Indian restaurant that opens in your local area, they've got no idea whether it's going to succeed or not. But under this, that's as much innovation as the next Canva. It might not seem it, but that could be the next sort of Indian global chain. So,
and apparently, it's a good investment according to RW here. There's my investment advice. I don't know what's going to happen with gold and Bitcoin, but eggs. There you go.
Derek, can I ask this asymmetry? Is this something that would be easy for them to fix with a regulatory or a legislative change, or is it necessary for the actual implementation of their policy?
Well, the simple fix is to say now you can index your real losses and offset them against your gains.
Yeah.
But they won't do that in practice, and they'll be steadfast not to. The reason why is everyone that's got a share portfolio at the moment is sitting on a large number of losses that they haven't yet realised. Like I myself have got losses probably in the 500,000 to $1 million range, and all of a sudden, if I can inflation index it, that becomes very useful for me. And all of a sudden, I won't have to pay CGT for an awfully long time because I can just inflation index all my losses.
Yeah.
So there's a simple fix, but they won't actually do that. And even if you do that simple fix, my other objection is it still taxes successful risk too highly, and that's what I don't like about it. But there is, to give you an idea, there is no reputable or internationally recognised economist that will say that this system that they're introducing, that's never been done anywhere else in the world, that this is actually an economically justifiable system. The idea that you tax winners, things that go up above inflation, you tax them, but you don't have to allow loss offsets for things that don't rise by inflation. There's no international economist that I know, or no reputable economist that would support such a system. So they have to do it analytically, but they're not going to do it purely for Treasury bottom line things, because it means that for the next 5 or 10 years they wouldn't probably collect any tax revenue as the losses sort of soak their way through the system as they're indexed by CPI. Does that sort of make sense?
Yeah, that makes sense. Yeah, I was just wondering why they don't just fix that, because that's That
That's
seems
the
to
obvious
be a
fix.
huge problem. Yeah.
What they're trying to do at the moment is they're trying to be in denial, where they're actually being dishonest with the treasurer, and they're not telling him the extent of the problem or the size of the problem. The treasury itself is engaged in a huge cover-up, and the briefings they're giving to Jim Chalmers that he's presenting to Parliament, they are dishonest lies. Jim Chalmers is saying that he's doing this to better align the labour and capital tax rate. In fact, the current tax on capital gains is 30%, and the labour tax rate is 27%, so it's already above. Under this new system, the capital gains tax goes to 55%, so it goes to double the rate of tax on labour. And the briefing notes they've given Jim Chalmers that says it goes from 19 to 21, they're not worth the paper they're written on. If you ask Jim Chalmers to release the modelling on it, he will refuse to do it, and the reason why is because then they'll be exposed for the frauds that they are.
So just building on Gene's question there, what can be done about this? So you say that strictly if they wanted to stick to the idea of just having capital gains tax applying to real gains, then they just need to index in both directions.
Index losses, that's right, yeah.
And to turn everything into a
real system, situation. A genuine real system, yeah.
Which makes sense theoretically, but as you point out, they might get spooked by the revenue loss. But I mean, if they're dedicated to doing it theoretically correctly, then maybe they'll just cop the revenue loss. Although maybe they won't do revenue. That. I'm being sarcastic. They were clearly motivated by revenue motivations as well in this. So the other obvious solution would be just to revert to the 50% discount style system. Yeah. And then I wanted to ask, is there anything else you see as a potential way forward? I got one other suggestion, just spitballing here. The idea that anytime you don't pay capital gains when you sell an asset, if you use the proceeds of the sale to buy another investment asset. So you only realize your capital gain when you take the money out of the capital markets and put it into consumption goods.
Yeah, that would solve the problem as well. But again, they won't do that because the revenue side will be terrible. They won't get any capital gains tax revenue for the next 5 or 10 years, I would think, under that.
Those poor darlings. I'm a big believer in tax cuts, Derek. So if you tell me it's going to be a tax cut, that doesn't dissuade me.
It's a good idea. I've got no problem with that system if they say you don't pay tax if you put it into a new investment. I've got no problem with that.
Well, that is one of my bugbears is the wrong word. The big issues that I like to push is I think that we should have a far bigger tax deductibility option for money that you put aside into savings. Yeah, basically a Caldor tax, right? So if you earn money and you use it to consume, fine, charge the tax there. If you earn money and put it away into savings, that money you put away into savings, or at least some amount of it, you should be able to put that down as a tax deduction. And then to roll that forward successfully, you would apply it to capital goods. When you buy capital goods, if you sell it, take the money out to consume, pay your tax then. If you sell it and then reinvest it, you get that tax deduction again because you just reinvested into another capital good. So
yeah, no, I think that's a perfectly sensible thing. I think it's a good reform. To give you an idea of the magnitude of this, just so that you have some appreciation, I'm calculating the capital gains tax as at least 50% and could be as high as 70%. The international average capital gains tax rate is 20%. So we're over 140% above the international average. And as I said, I've circulated the video of Albanese being unable to name one country with a higher capital gains tax rate on real gains, and no one's able to do it. And I'm confident
it does get quite messy. It does get quite messy doing comparisons, though, of course, because other countries are charging their 20% on nominal returns. So depending on the level of inflation, a 20% return on nominal returns in a high inflation economy could be a massive real capital gains tax.
Typically, it'll go up. The 20 will go up to about 30. If you use an average holding period and average inflation. Remember other countries as well, like things like the US, they may have a much higher ratio of capital return to dividends. So most of their return is through capital, not through dividend. So and that would tend to dominate the market. So yeah, I agree. You can adjust the 20 up to 30, but as I said, there's nowhere that's coming out in the sort of 70 to 75% range, which is where on reasonable assumptions we're coming out at.
Well, I wonder what the high inflation, I mean, most of the Western world, when we say high inflation, we're talking up to 10%. But of course, there is Latin America and other countries. If you did get painfully high inflation, you would probably get painfully high implicit real capital gains taxes in those economies.
Yeah, you might. It's theoretically possible.
It might actually explain why there's partly explain why there's such poor investment outcomes in
exactly
those countries if they have nominal capital gains tax systems.
Yeah.
All right. What would you do, by the way? What if you were made treasurer tomorrow after you apologised for the mess you have just left behind? What would you just go back to 50%, Derek, or what would your plan be?
There's an even simpler fix than this, but might politically work for the government, and it's a slightly better system. Is what they've said for new housing, because they wanted to stimulate investment in new housing. They said, look, what we're going to do is we're going to give you a choice. You can either choose the 50% discount or you can choose inflation indexing. So if the government was clever about this, they'd say, oh, look, yeah, we've heard investors' concerns, etc. What we're going to do, there are strengths of both systems and there are weaknesses of both systems, is going forward, we will give you the choice. You can either choose the 50% discount or you can choose inflation indexing. And you do something to be revenue integrity. You say, look, you can't choose it between stocks, but in 1 year you can either choose the indexing method or you can choose the 50% discount method each year. And that has the benefit, if we do have very high inflation, some people will choose the inflation indexing because it can work out better. But if we have low inflation, and we're taking high risk investments, people will choose the 50% discount. And that suits the high risk, high return investments better. And if they're saying they want to stimulate investment, and stimulate investment in new housing is done by giving people choice, you run that same argument for shares. The whole idea of doing this with shares is, I said, we want more people to invest in shares and less in owner-occupied housing. The way to do that is giving them choice between the inflation indexing, which could work better in limited circumstances in a high inflation environment, and or 50% discount. That's what I'd do if I was politically playing it. They might be able to get away with it. If not, you could do the straight reversal where you go to 50%. And look, to be honest, I only began looking at this closely just recently. It turns out the 50% discount does tax capital a little bit highly. As I said, the average tax rate on capital is 30%. Most of the economic theory, or there's commonality in the economic theory, it says you should tax capital slightly more lightly than labour. The labour tax rate is 27%. So we should be trying to get that capital gains tax rate down to about 20% from the current 30% it is on real gains. The way you could do that is you could either increase the discount from 50% to 55 or 60, or you could just do an adjustment, say in high inflation times, for extra compensation, we're increasing it. If inflation's above 3%, in any year it's above 3%, we're increasing it to 55, and in any year it's above 4%, we're increasing it to 60, something like that. That would work as well. But keep it simple. The current system is very simple. I'll give you a classic example. You can have 10 stocks. Say you put 1,000 into them at the end of the year, you earn $100. You can really simply calculate your capital gains tax. It's just your buy price of those 10 stocks versus your sell price. You got $100 gain. What's your marginal tax rate? You've held it over a year. Marginal tax rate, you halve it, and then you multiply it by 100. Say if you're on 16% tax, goes to 8%. You're paying $8 tax on that $100 gain. If you buy those same 10 stocks under this current system, this new system, they're introducing, you will have to do about 30 separate calculations to calculate what your tax is, because you have to inflation index every one of them. You have to find out those that don't beat inflation, those that do, and then you have to semi-adjust for all of that sort of stuff as well. And the tax you pay is completely arbitrary. You might pay $30 of tax, you might pay $50 of tax. You got no idea, because it's the distribution of returns amongst those 10 stocks. So you could ask Jim Chalmers a very simple question. Look, if I've got 10 stocks, invested 1,000, they go up by 100, what's the tax I pay? He won't be able to tell you. He can't answer it. And it's a really simple question, whereas under this current system, I can tell you exactly what tax you pay. You just take the $100, multiply it by half your marginal tax rate, that's the tax you pay. So the big winners from this, I'll tell you, the big winners from this are the tax accountants. They will have no one will be able to do their tax returns anymore. Yeah. The tax accountants will have 5 times the amount of work that they previously had calculating capital gains. And the other big winners from this are what I call the financial structurers. So there's another very simple way around this. If I want to invest personally in shares now, rather than investing in 12 shares, I can invest in what I call, I'll get a financial structure. So can you create me the Derek Francis ETF? I'm still going to buy them, but I want them owned under a single ETF structure. And as soon as I get it under the single ETF structure, then I get the average of all of them rather than the distribution, and I avoid the diversification penalty. So there'll be all these financial structures
Wait a
that come
second.
out.
I mean, haven't you stumbled across a potential solution for the government? I mean, again, playing devil's advocate, if I was in Jim Chalmers' shoes and I was dedicated to trying to save the structure of my reforms, how about the government just, I don't know, gets the banks, subsidizes the banks, encourages the banks to roll out a series of just... yes, it's off-the-shelf, personalized ETF structures. Everyone go into your bank. They'll just open a personalized ETF. And so you go, you do your online banking. You've got your account. You've got your home loan. You've got your ETF. Anything you want to do, you do it through there. You only pay tax when you take it out. I mean, it's actually... That's actually functionally similar to creating a little fund where when you sell the share, you don't pay tax on it because you've reinvested in another share, like what the proposal I was making before.
No,
that could be a solution.
I agree with you 100%, John. It's the solution for any new investments, but the problem is all the current investments you've got. You can't sort of liquidate them and put them into your new ETF unless you incur a shitload of capital gains tax on that as well. So it works for new investments if you create the personalised ETF, but it doesn't work for your current investments. And my second guess is the government just won't do that and or encourage it.
What's the transaction costs in moving your shares into the ETF? I mean, if the ETF's in your name and the shares are in your name, then the government just has to be sufficiently committed to coming up with a way to allow you to transfer the asset.
So you're saying you can transfer it into this new entity. I think as soon as you do a transfer into a new legal entity, that has to incur capital gains tax.
It's up to the government, isn't it? That's what I'm saying. If I was the government trying to work out a solution here.
Well, possibly.
All right, that's good news, everyone. We have just solved the problem.
Well, now, can I ask?
If you could all just write an email to Jim Chalmers and let him know to watch this episode, we have fixed his problem.
Yeah, can I just ask? There's a question in the chat about how would someone actually build their own ETF? Is this setting up a company? Is it that acts as the manages the ETF?
This is getting way beyond my expertise, but all I'd say is there is a new market for what I describe as ETF financial engineering, where you get some company and they'll say you can construct your own ETF, just go and buy your shares, but buy them through us and we'll call that an ETF and we'll do it as one single unit fund that's your unit fund and it's a single product, single return type thing. That would be the way I'd see it operating. I don't think people could construct their own ETFs, and there's problems with company structures as well as there's problem with company structures in the current trust because they're doing a minimum 30% distribution from trust as well. That's what I'm saying. They're not actually going to collect any tax from this because it's so punitive that anyone that's got any smarts will construct ways to avoid it. But there's going to be a whole new market in what I call financial engineering, sophisticated financial products that doesn't actually do anything to grow the economy at all. It's absolutely useless. It's just a whole lot of basically BS that we're doing to jump through hoops to avoid this, what I call the diversification penalty.
Yeah, and unfortunately, if they don't allow us to create ETFs or the equivalent of our own private managed funds, the self-managed super funds, we need our self-managed.
We need our self-managed private fund. That will work.
So if they don't do that, what they're effectively doing is saying you just have to go via your super funds, your big bank managed funds, and sort of international conglomerates. So that goes back to the point that they're centralizing capital again. They're doing the exact thing the left is supposed to be against and funneling capital into the fewer and fewer hands of fat cats. So
exactly.
Anyway, having given us all of that depressing insight, before we go and top ourselves, we'll move on to one extra topic for the evening. Gene, did you have another question on this, or can I?
No, I think that was really good, Derek. I learned a lot, and very valuable insights. And I thought that discussion of the tax asymmetry issue, that was great, and then understanding why they can't just fix that easily because of the revenue impacts. I think that was very insightful. So
thanks.
All right, so a bit of a change of pace. The next segment for the regular listeners, you'd know I go through the ATA Death and Taxes newsletter for the week. The newsletter came out today. If you're not getting it, please go do and sign up. It's on Oz Taxpayers, austaxpayers.substack.com. We send you one email a week. It's not a big one. We don't inundate you. No spam. You can sign up for free. If you like what we do, please consider becoming a paying member, but you can sign up for free if that's what you prefer. And of course, since you have signed up, dear listener, you would know what the email was today that we sent out. Budget season is over. Finally, all of the federal, state, territory governments have all finished their budgets. So I've done a bit of a deep dive, a medium-sized dive into all of those budgets, tried to take out the various pieces of data and work out which states have done a halfway decent job, which ones have done a terrible job. And those are basically your options. There's no good job option, unfortunately, amongst our state budgets. But what have I found? So the short version, one thing I want to note, and it says it at the beginning of the newsletter, of all of our states, territories, and federal government, that's 9 budgets we've had in the last couple of months. Not one ran a fiscal surplus, not one. 0 out of 9 managed to balance the books. Now, 3 states did run an operating surplus. And of course, they've managed to convince the media that that's the number that they should be putting on the front page of the newspapers. An operating surplus does not consider net capital expenditure. All of those states that say they're running an operating surplus are still going further into debt. Because when you spend more money on capital, it still needs to be paid for by money that actually needs to exist in the real world. You can't theorize it away when you're buying something. You can only theorize it away when you're telling a journalist not to report the correct numbers. So yes, a few states had an operating surplus. None had a fiscal surplus. That is a sad state of affairs. Now, to be fair to our friends in WA, last year they did have a fiscal surplus, and in the forward estimates, they predict to get back to a fiscal surplus. So they seem to have just ducked into a fiscal deficit this budget year. 2026-27 is this budget year.
They get the favourable treatment from the Commonwealth. They had that special deal.
Well, you say special deal, they don't get to keep their own GST, right? So the special deal is that they get screwed slightly less than they should. I'm a big believer that GST should just go back to the states where the GST was raised, or to make it easier, just do it on a per capita basis. We currently have a model in Australia where the federal government pretends it's a state tax. They hand GST back to the states, but they don't hand it back to the states where the GST is raised. They hand it back to the state. If you are an inefficient state that's introduced bad policies, you've got low productivity and your people are getting poorer, the federal government will reward you for your incompetence and inefficiency, handing you more of the GST revenue than you deserve. If you're an efficient and productive state, you introduce a bunch of really good reforms, you get your state humming along nicely and you're getting richer, the federal government will punish you and make sure you get less money for that. You get taxed for competence, rewarded for incompetence. It's just like the welfare state, but done at the level of state governments. So I'm quite sympathetic to our friends in WA when they were at one stage told for every $100 of GST that is earned out of WA, you were going to get 60 back. And that other $40 you're going to have to mostly hand over to Tasmania and South Australia. And WA came out with what you call the sweetheart deal, where they said, no, look, I only want you to screw us down to 70 cents in the dollar. And so that's WA's sweetheart deal, is they're only being screwed out of $30 out of every $100. 30% of their money is just being taxed to hand over to Tasmania and South Australia. So you could call it a sweetheart deal. I still think they're getting screwed, quite frankly.
Maybe want to come back? I don't want to distract us from the main point, but I think we should have this conversation another time, because wasn't WA getting funds? Weren't they benefiting from horizontal fiscal equalisation for many decades before they hit it big with the iron ore royalties? Yeah. So it's the iron ore royalties that are screwing them over. That's the reason that they're getting done over on the GST. But for decades, they were actually benefiting from the system. And now, oh, hang on, we might lose out of the system, so we've got to get a special deal. That's why I'm outraged about it. That's why Saul Eslake's outraged about it.
Well, look, I agree that at one time in history, decades ago, WA used to be a welfare recipient on this federal fund transfer. And I agree that the states seem to have a very convenient set of principles where when they're a net contributor to the GST pile, they suddenly see things my way. And if they're a net recipient, then they suddenly run screaming in the opposite direction to what I'm saying. Look, I'm not saying this out of any love for WA. I'm saying this because I think what I'm proposing is the best tax system to encourage good productivity enhancing reforms at the state level. And if we continue subsidizing you for making bad decisions and taxing you for making good decisions, we shouldn't act surprised when state governments make more bad decisions. So that, look, I agree. WA is making their claims out of self-interest. I am not making these claims out of self-interest. I'm not from WA. It so happens that their self-interest, in my opinion, currently aligns with good economics. So anyway, that notwithstanding, my point is WA's budget, while they did dip into a fiscal deficit for this year, which is a shame and they shouldn't have, all things considered, and when it comes to debt and deficits, the WA gets an honourable mention. They are still leading the country in terms of debt and deficits. Having said that, the Australian Taxpayers Alliance, when we issued our Treasurers Awards, which we've just started today, the pecking order of the best and worst treasurers, it is not based on level of debt and deficit. Right? There's too many structural historical factors that go into the current year's debt and deficit, especially the debt levels. So what I've looked at is the level of real per capita spending change from year to year. So the spending change, but then I adjust that for inflation, the state level inflation out of the state budgets. I adjust it for population growth, the population growth estimates out of each state budget. And from that, you get the real per capita change in spending. And I think that is the correct metric to be looking at. Right? And I've been arguing that in the federal context for a long time now, so I'm just being consistent. Looking at those numbers and finding out which states actually managed to show what I've called spending restraint. Have they kept real spending per person constant or got it actually going down? And several states have got their real spending per person going down. So that was quite pleasing to see. The winner of the state that has most successfully reduced government spending per person, both the budget year just finishing, the current budget year, the highest reduction in the current budget year, and then continuing to see reductions in the next 3 years, is Tasmania. Now, I should say Tasmania started this process with their budget in a very poor form, right? They had a large deficit, they have high debt. So this is an improvement over these 3 or 4 years. It still means if you look at the total debt level, WA has a much better debt level than Tasmania as a percentage of their state economy. But in terms of the trajectory they're on, I'd say Tasmania, I would argue, has done the best job at getting spending under control. And the reason I'm looking at spending here is that is the underlying cause of the runaway taxes. Like the taxes are too high, they're strangling the economy, they need to be brought down. But the taxes are that high because the spending is too high. And the same thing with debt and deficits, right? The debt it's not huge by world standards, but I would argue it's higher than it needs to be and it's trending in the wrong direction. And if you want to address the debt, again, you have to address the underlying spending. So this is why I've used the trend, the change in real spending as the primary metric through which I have judged all of these treasurers. Tasmania wins. And of course, Tasmania's state treasurer is former, I think, leader of the government in the Senate, former senator for Tasmania, now treasurer for Tasmania, Eric Abetz. So announcing today that the ATA gives Eric Abetz the Treasurer of the Year award based on these numbers, which I think Gene's going to argue with in a second.
Insulting me, but that's okay.
You can give your dissidence report. So in second, I've put in, and this was a kind of a tightly run thing, but for second, I put in Daniel Mookie from New South Wales. So New South Wales has the second largest decrease in real per capita spending. Interestingly, the last 2 states to bring out their budget was Queensland and New South Wales. I am a Queenslander, but when it comes to these budgets, New South Wales won the fiscal state of origin, so to speak, right? So Queensland government increased spending in the financial year just finishing, have basically got it even in the current year. And compared to New South Wales, they have not shown the same level of spending restraint. So kudos, of course, Eric Abetz from the Liberal Party, Daniel Mookie in New South Wales from the Labor Party. So perhaps a less expected outcome, but kudos to him. The other bright spark before we go to the also-rans is the Northern Territory budget, which of course most people don't spend a lot of time watching. To be honest, neither do I normally, but I was trying to be thorough, so I went through all the budgets. And the Northern Territory budget doesn't have a huge reduction in spending this year, but it had a decent reduction in spending last year and next year, and the fourth biggest reduction this year. So you put all that together, in the long run, Northern Territory has the biggest spending reduction predicted over the forward estimates of the budget. So I read Northern Territory, I've forgotten the guy's name now, Bill something, Bill Yan, or apologies to the Northern Territory Treasurer, but you got third place in my list. The also rans there. Look, Victoria and the federal government were ones in the middle. They were uninspiring, but not terrible by the standards of the other states. The ones that were quite disappointing, as a Queenslander, I put the Queensland Treasurer, David Janetsky, in at 7th, 7 out of 9, which is not the outcome I wanted. But their spending restraint was the 7th biggest last year, 7th biggest this year, 7th biggest next year. It just seemed too consistent to be able to give them a better rating. And that is a bit disappointing, given you were supposed to have better spending restraint nominally from the right side of politics. I put that down to the fact that I think the LNP, the Liberal National Party in Queensland, is still spooked from the ghost of Campbell Newman. And they're still a bit too scared to do the right thing on spending restraint. But that is not a good outcome. And South Australia came in last for my list. If you look over a 2 or 3 year average, they are increasing the size of government larger than any other state, territory, or the federal government, indeed. So that's a bit disappointing coming from our South Australian brothers and sisters. Now, I am a big advocate for competitive federalism. And I am that because I think it is the only thing that keeps our politicians in check, their fear of losing people and capital taxpayers to the other states or to other jurisdictions. So in the spirit of competitive federalism and hoping that the treasurers are all trying to outcompete each other, I encourage everyone who didn't win this year to go out, cut spending more, cut tax more, cut regulation more, and then next year you can be awarded ATA's Treasurer of the Year. So, gentlemen, that is my wrap up.
Okay.
I'm sure you've been reading your state budgets because, I mean, what else do people do in their free time? What's your thoughts?
Well, I should jump in here. I mean, I was shocked when I saw Eric Abetz as number 1, Tasmania as number 1. Now, look, I like Eric Abetz. I think he's a gentleman. I've had a little bit to do with him. Well, Nicholas Gruen and I spoke with him about the Hobart Stadium work, the cost-benefit analysis that Nicholas did that I helped him out on. So I think he's a decent person, and he is cutting the public service. He's had to sack, I think, 1,500 public servants because they've got this huge debt problem. So he is responding to that. So full credit to that. But the issue I have, and why I think there's no way that he should be number 1, is that they're proceeding with this stadium that they can't afford in a location, a waterfront location, that is a terrible place to put a stadium. And, you know, this thing's going to cost $1 billion, $1.5 billion, maybe even $2 billion, given the potential cost blowout. So why would you do this when you're already heavily indebted? You've got a state with the worst education outcomes in the country. A football stadium's not where you should be putting your resources. And this is, you're looking at general government expenditure, and you're not considering what's happening in the GOC sector, the government-owned corporations, off budget, where they're spending like madness, and they've had problems managing their ferries. They bought the ferries. They haven't got the right infrastructure at the docks for the ferries. It's been a complete disaster in Tasmania. So yeah, John, I would disagree strongly with your choice of number 1.
Look, I take your point. There are going to be things left out. There's lots of things I didn't include in this metric. I tried to focus in on the metric of change in real per capita spending. And so I had to overlook lots of things. Like, I have complaints about the New South Wales budget. I gave them second, but they don't index their payroll tax or their land tax thresholds, as lots of states don't. And so there's bracket creep. They used to index their land tax thresholds and took it away precisely so that they could benefit from bracket creep. So I'm not a fan of that. Unfortunately, this was a relative comparison. My first answer would be, if I'm objectively measuring all of our state, territory, and federal treasurers, they all fail. But So if I'm comparing them against what we actually need at this point, where we face an uninspiring future of stagnant productivity and ever increasing debt, and we just keep going with stagnant productivity and rising debt until we fall off a cliff and then cry about it. In that context, I would argue we need serious reform. We need reformist-minded treasurers who actually cut spending, not tinker with it, not down by 0.5%. That's better than up. So, pat on the back. But no, we actually need to seriously cut spending, seriously cut tax, seriously cut regulation. And the spending we do, we need to rethink the way we do it so we get best bang for our buck from the government spending that remains. So I am, in an objective level, I fail them all. But then the second question is on a relative level, which is perhaps more interesting for people following politics, right? Because there are only 9 horses in this race, and I might say that they should all lose, but one of those horses has to come first. And look, it's hard to give it to a lot of them. I mean, Jim Chalmers, he didn't blow out this level of spending, but it's very hard for me to give him best treasurer given his tax reforms. So I've got to rule that one out.
Yeah.
WA's actually increased spending this year. South Australia's increased spending by the most over either a 2 or 3 year average, whichever you prefer to use. Queensland increased spending last year and has got uninspiring cuts going forward, no tax cuts. It's hard to give anyone the gong here. It seemed that in terms of serious budget repair, Tasmania and Northern Territory and to some degree New South Wales were the ones that seemed to be giving it a go. And I know New South Wales' result was somewhat due to actual reform that happened over the last year. And there were serious spending cuts coming out of Tasmania. So look, it's not a glowing endorsement of Eric Abetz, but I had to pick someone. They all have an asterisk next to their name when I give them their number. But you could quibble about the order, right? I'd say those top 3, you could make a case for rearranging those top 3 in any order, but you're going to struggle to put Eric Abetz behind Jim Chalmers, I think.
Yeah, but John, you've looked at which spending did you look at? You looked at general government spending, did you? I mean, what if you looked at total spending, including the GOCs as well? I mean, maybe that's something you could crunch too. Yeah, I know the tricky. Yeah, go ahead.
Well, there's several tricky parts there. One is these GOCs should be nominally worth something. So maybe they've been mispriced on the books, but then if I'm going to go through the books of each state's GOCs and revalue them all in my own image, it's going to be very hard to give an objective metric to compare them all. I doubt Tasmania is the only one to have a mispriced GOC on their books. So only adjusting one would be unfair. And look, realistically, if they do have some value, then at the end of the day, financially speaking, they could be sold and it would all be a net from the government perspective.
But you look at what they're doing with this stadium, right? They've got this Macquarie Point Development Corporation, but what's it? It's a GOC, and so this spend. They're saying, well, all this debt, it's been borrowed by the MPDC. It's not being borrowed by our general government. Where, I mean, the additional debt, they are contributing to it, but they're saying, well, if the cost blows out, it's the MPCD that'll wear that. But this stadium's going to lose money on an ongoing basis, and they're going to have to subsidise it. So it's effectively a general government spend. That's how I see it, and they're disguising it. It's off budget.
You may well be right. The problem is they would not be the only jurisdiction doing this. I mean, we've had grants before. Our complaints about, especially the federal government, putting things off budget consistently. Then it's difficult to get to the bottom of it. Either we have to kind of take it at face value, or we have to rework our estimates for the profitability of all of the government-owned corporations. So I don't really know how I could do an objective, easy metric there. No, I'm not trying to let the Tasmanian government off the hook there. It's very easy for me to believe they are mispricing their assets, and therefore they're going to end up having to bail out those losses being made by government-owned corporations. It's very easy for me to believe that because it happens across nearly all of the jurisdictions. Maybe there's one particularly big one going on in Tasmania at the moment, but there could equally well be 2 or 3 big ones happening in other states that we just haven't been paying as closer attention to. So,
but
anyway, like, I had to have some sort of metric, right? It couldn't just all be my vibe. So I had to use a metric, and I chose to use general government spending trends in real per capita terms. Maybe that's the wrong metric. If you believe that's the wrong metric, ladies and gentlemen at home, please do write in, give me other suggestions. I'm happy to read them. If I disagree, I'll disagree, but I'm happy to read other ideas.
Well, I will agree that Eric Abetz is doing some good work in terms of getting the public service under control. So I'll give him credit for that. I guess I'm just too personally, maybe it's too personal for me with the bruising that Nicholas and I got when we appeared before one of their committees when they were, because they're all pro-stadium down there. And so because Nicholas had the audacity to question the economics of that stadium, we ended up getting raked over the coals at a parliamentary committee. So it's all a bit personal.
Understandable. Derek, do you have any thoughts on the battle of the treasurers?
Yeah, look, just one thing quickly. The whole idea of calling Jim Chalmers what he's done as tax reform, to an economist, it is an oxymoron. Can I explain what tax reform is? All taxes have what's called an excess burden. Jean, you'll know this, that any tax distorts economic behaviour. And typically the excess burden is somewhere between 2 cents for a land tax, which is very non-distorting, versus things like labour income tax, capital gains tax, which are at sort of 50, 60 cents in the dollar. What he's done is he's increased the taxes with a very high excess burden. So if you move from a tax with a high excess burden to a low excess burden, that's tax reform. Or if you reduce tax, that's tax reform. What he's done is the exact opposite of tax reform. It is, let's choose a really inefficient tax and let's jack it up even higher. And what it does is it decreases it. So the whole idea, of course, in this tax reform is it is vandalism to the word tax reform, calling it tax reform. It's not tax reform at all. It's clearly the worst budget of any, because he simultaneously managed to increase the tax rate, but probably reduce the total taxes collected, which gets the award for the worst possible set of reforms you could possibly do. Look, in terms of the other state budgets, I'm just not across them, so to speak. So I couldn't meaningfully comment. I will say that WA starts from a very endowed position because they get all the royalties from iron ore, etc. That makes it very lucky for them. And the other thing is, Victoria's budget pain is partly self-inflicted. They go banning gas mining, gas exploration, all the things that could generate royalties. They've basically banned. And so their incompetence and their terrible budget position is basically all because they've shot themselves in the foot and they deserve what they get. And I would say of any state budget, Victoria is clearly the worst over the last 7 or 8 years in terms of, since Edward Dan Andrews got in, Victoria's managed their state budget the worst of any state, and it's by a long way.
Yeah. Derek, you reminded me of something where you're talking effectively about a Laffer curve. I mean, that's what we've done with cigarette excise. And I mean, Sinclair Davidson's been brilliant on that lately. So, with all of this, the funny, the ironic posts.
It's the Laffer curve,
Why weren't we warned about this? And of course we were warned, including by Sinclair.
I'll tell you a funny story on that, Gene, as well. So my brother Jeff, he produced an internal Treasury briefing saying, "Look, if you do this increase in tax, it's going to decrease the tax revenue," and he was shut out. They said, "We don't want this research coming out because it's not the Treasury way," and he was shown to be right. So,
well, it's not the Treasury way because Treasury just assumes that people never respond to incentives, which is a remarkably dumb assumption, which we just know is wrong. So, Look, I take your point. Maybe I should have called it tax deform instead of tax reform. We have written about that before here. I think I used that meme from the Princess Brides where they say that word, I don't think it means what you think it means. And it is quite remarkable that Labor has a productivity roundtable. And the only thing that seems to have come from it is increasing taxes on capital, where capital has some of the highest behavioral responses in the country. And by the way, you mentioned that the excess burden or the deadweight loss can get up to 60%. It can get much higher than that.
120%.
There are some. You can get over. You can get into the thousands, right? I mean, it can get crazy when you're taxing people that move very quickly. And there are some subpopulations. Like on average, the income tax, I think deadweight loss they've averaged at about 30 or 40%. That's the average, including a lot of people have a deadweight loss of about 5%. And then some people have a deadweight loss of like over 100%.
So can I tell you what genuine tax reform would have been if they'd said something like, you know what we're going to do? We're going to implicitly raise taxes on land values by no longer cross-subsidising local councils so they have to put up their rates, which is essentially a land tax base, and then cut income tax and capital taxes in exchange for that. That would have been genuine tax reform, and it would have also held local councils far more accountable for their own expenditures. That would be something that would be, it creates a win-win. And it's also equitable as well, because the people that traditionally own the sort of dwellings, etc., typically are much better off than the people that don't. So,
sorry, can you say that one
That's
again?
a clever idea. Yeah, I like it. Yeah, go ahead.
Could you so at the moment, there are huge cross subsidies going on. Local councils, with their funding, they get about 50% of their total funding from both state and federal governments. If the federal government said, you know what, I'm not going to cross subsidise you, I'm not going to give you any funding, you have to, for all your local infrastructure projects, you have to raise it from your local community. They raise it through raising their own rates. And the rates base is actually a very efficient base, because that's basically a capital improved value tax base. And then the federal government could have said, look, because I'm no longer cross-subsidising you anymore, I can use that to decrease both income tax rates and capital gains tax rates. That's genuine reform, because it's moving from a system that has taxes that have 30 and 50% excess burdens to a tax that has a 2% excess burden. And it's also very equitable and fair. It's taxing the people who have high wealth because they're large property holders. It's taxing them a little bit more highly.
Well, let me play devil's advocate on this a little bit. So I believe most of the council funding comes from the state governments. And the state governments, I believe what that is it's basically similar to a GST system where the state governments have introduced new taxes on behalf of the local councils, raised it, and then passed the money on to the local councils. Now, that's a bit of a cockamamie roundabout scheme, but there would have to be something to recognize the reality of how that came about. That also doesn't really allow you to cut the income tax or CGT, which are federal. And as I understand it, there is some money coming from the federal government. But what that's designed to do is basically incentivize local councils to stop saying no to all the bloody development they're stopping. So if we want more housing, we'll need to do something about that. May I suggest another solution to this problem? Just abolish all local councils. That's beyond my expertise. Look, I agree with you. It's a roundabout mechanism of what the federal government could do is say, we know the states you're funding the local councils, whatever you're funding them, I'm not going to give you GST revenue associated with that, doing it. So you can keep the cross subsidy going if you want, but we want local councils to be self-sufficient with their funding. Yeah, you can get to my solution, is what I'm saying. Yeah, you have to be a little. I've come to the conclusion that if we keep looking for tax reform solutions in the idea of rejigging our tax system, I don't think we're going to get the sort of change that we need in our economy to actually kickstart productivity and get us moving forward. I think the fundamental problem is that the government is just far too big now. I agree with that. We need to cut spending and actually cut tax and replace it with nothing. Not replace it with another tax, a better tax, a more efficient tax. Cut tax and replace it with nothing. And that'll be the way we get to drive productivity.
If you had sacked everyone in the Commonwealth Treasury and not done this tax reform, this CGT reform, the economy would be about 5% bigger than it currently is. So I can honestly say they've had negative productivity with whatever they've spent their time doing. It is negative to productivity and it's negative to GDP. So
Treasury's been all downhill ever since 2005, was it? I mean, Gene, when did you leave Treasury?
I left 2009. When did you leave,
2009. 2003. So it's been all downhill since 2009, I think.
Yeah, I'd say so. Well, that was the year. Yeah. Anyway, we won't go through it all.
Anyone in the Productivity Commission that oversaw this reform and said it was actually good reform sacked them as well, I think, because anyone that sort of studied first year economics should have been able to work out that this was terrible and would crunch the economy.
Yeah, I haven't said it this time when you've been here, Derek. My theory for why they went this way on the capital gains tax is they were dedicated to reducing the subsidy. They were dedicated to increase capital gains tax. But there is no subsidy. That's a myth. It's a myth that it's subsidised. Yeah. Okay, but the reality notwithstanding, the politics of the issue, they were dedicated to doing that. They looked at what happened to Bill Shorten and they thought, if I go from a 50% discount to a 40% discount, everyone will see what I'm doing. Yeah. I'm clearly increasing tax and they'll see it. If instead I switch to cost-based indexation, nearly every voting Australian, their eyes will glaze over, they'll fall asleep, they won't understand, they won't care, they'll just go and pick their kids up from netball practice and just ignore the whole thing. And I think they were banking on the fact that it would just be too mind-numbingly boring and complicated and they'd get away with it. Now, I think they have miscalculated here. I think the pushback has been large enough, and maybe they've come to regret it. But I think that was their reason for going this way.
Look, probably, but the whole idea of calling it a 50% discount is a misnomer. What it is it's a compensation for inflation. And so it depends on the relative ratio of your capital gain versus the inflation rate. And I've done a lot of maths on it, and essentially the 50% discount doesn't quite compensate you for inflation. And if you look at Treasury's own analysis, it's page 149 of the budget, BP1. They've concluded that over 20 years, the 50% discount undercompensates for inflation by 4%. So you can no longer run this argument. You can look at BP1, page 149. They've done the 20-year analysis. You can no longer run the argument that the 50% discount is a discounted capital gains tax. It's not. Treasury's own analysis says it overtaxes by 4%.
Yes, I take your point. I also think it's a mistake to be taxing the time value of money, which is why I've always said that you need to have that extra 2% in there on any cost-based indexation.
I like
it. But having said all that, I was using the word discount in a non-judgmental way, just to say that if it was 30, it's now 15, so that is like a discounted number. But I take your point. We have to be careful about the moral loading that we use in our language, especially the people who enjoy increasing tax and spending. They're very good at morally loading their words. So maybe we need to be better at playing their game.
It's exactly right. The standard person that can't do maths, they just sort of think 50% discount, I'm getting a 50% discount on my tax. Nothing could be further from the truth. It's not a discount at all. Once you play the maths of it, it actually taxes capital slightly more highly than labour.
Yeah.
I mean, maybe that was part of the solution here. They just need to change that word to adjustment, a 50% compensation or a 50% adjustment.
Yeah,
I mean, adjustment is probably the most morally neutral.
Yeah, it's a 50%. That's the other mistake Howard made when he just says it should be a 50% adjustment for inflation.
Another good solution here, Jim Chalmers and the Liberal Party, if you're watching this, Tim Wilson, take up these ideas. I think
John,
we're coming up to...
I think we've talked about this enough, but now they're doing the two-party preferred calculation with One Nation. The Liberal Party's become irrelevant.
So I should say Barnaby Joyce. I believe he's the Treasury spokesperson for One Nation now. So he would be the shadow treasurer. Barnaby Joyce. I think Barnaby Joyce would enjoy a lot of the ideas we talk about here. So maybe we'll.
He's at least an accountant, isn't he? He'd actually be more qualified for treasurer.
Can I just make one comment on this as well? That I think the Labor attack against One Nation is they don't have any policies. I actually think that's a good thing if they don't have any economic policies. These policies that Labor are introducing are terrible. If One Nation says I'm abolishing this CGT and I'm not going ahead with it, you immediately get a 5 or 10% increase in growth. I want a government that doesn't have policies and just leaves us alone to create our own wealth, rather than all this stupid fiddling with markets that destroys our wealth and destroys our prosperity and destroys our happiness. Best thing ever.
2 points on that. 2 points on that. One is that the government seems to have this instinct to do things, right? They think the fact that they're doing makes it good. I have this radical idea that they should only do things when the benefits of that thing exceeds the costs. Crazy idea, I know, but that seems to the government seem to run by the mentality of we must do something. This is something, so this must be done, which is a very unfortunate. That's supposed to be a joke, but it actually describes reality. Yes, Minister was a documentary, not a comedy series, unfortunately. But the other thing just to note on that is One Nation actually probably does have the most detailed policy manifesto that's out there. It's become a meme that they don't have policies. They've got far more written policies than nearly any other party out there on their website.
I agree. It's a myth.
You can not like them if you don't like them, but I don't think it's accurate to say they've been. And I think a lot of that comes down to Malcolm Roberts, who is a bit of a policy writing guru, as far as I know. But anyway, that aside, go ahead.
I was just going to say the one thing, and this is an absolute winner, is the income splitting policy. Now, any person that's actually understood their first lecture in welfare economics, that is actually what you call Pareto efficient, because you get the family unit should be the basis of decision making, and you get everyone then facing the same marginal tax rate, which is what you want for Pareto efficiency. So it produces a win-win. Any one economist that wants to argue against it, I would argue they haven't understood their first lecture in economics. So it's an absolute winner of a policy. It's economically elegant. It will grow the economy. And it also means that families make efficient and rational decisions on work versus looking after children. And the other thing it does is that it values the raising of children by parents. And the children are our future human capital. So the best thing you can do for productivity is actually income splitting. And when everyone's talking about this paid parental leave thing and all of that and whether she supports or not, that is a diddle versus what they're going to get in the income splitting. If they have actual genuine income splitting, that will multiply 5 or 10 times over what you'd get from 3 or 6 months of paid parental leave. So it's typical of the press focusing on the wrong issues. The income splitting is an absolute winner of a policy.
Yeah. I think
we've been pushing that here for over a year now, coming out of ATA. I think we had an episode on it a couple of weeks ago, and I think we were trying to take credit for it last week that Matt Canavan's embraced the policy for the National Party. One Nation's embraced the policy. Lots of minor parties, People Party, Libertarian Party, they've all embraced the policy, and I think it is both morally right and economically right. So,
but Derek's, I think that justification, that rationale. I don't know. Have you used that one before, John? I think that's a novel one. I quite like. I think that's a clever one that I haven't heard before. That
the Pareto optimality.
You have all of the people in the family. The family's the decision-making unit. They're all facing the same marginal tax
rate. So they're going to make efficient decisions on work versus leisure. They're going to send out the most efficient person to work, and the person that's best placed to look after the children, they'll send them out to dedicate them. So it increases specialisation of labour and increases economic efficiency.
Yeah. Well, you can achieve that without taxing it on family unit. My point has always been that we've got the tax system applies to the individual, the welfare system applies to the family, and that creates a two-tier distorted system. Yeah. As long as you are consistent, in either way, becoming consistent, either allowing income splitting on the tax side or just doing welfare at only an individual level, both of those would effectively create a bigger benefit to the family unit. So we've created a tax welfare system that is on both sides biased against the family unit. That's been my pitch, right? Pick one way or the other, but be consistent and fair. And consistent and fair would be better for the family. And I also think that's just a good thing anyway, because families are a good thing, but that's a different topic. Look, we're getting up to 2 hours. We can keep talking. I thought we'd start going through some of the questions. As we go through those questions, if you were about to say something, Gene or Derek, just after I ask the question, ignore the question and say whatever it is you were going to say anyway. So, but I think I want to start getting through these. This is a flashback from the beginning. There were some of these from the earlier time. How do you deal with the CGT with gold? I guess you just have to pay it, don't you? Like you were talking gold before, Derek.
The CGT with gold is no different to anything else. You just get a cop it. It's the same as any other asset. Yeah.
The question here, how on earth can we have such poor modelling coming out of Treasury? None of this budget makes sense. Yeah, I've got bad news for you, Kate. Sorry, go ahead, Gene.
Well, I was going to say that in defence, to offer some defence of Treasury, this is not how they would want to have implemented this. Ideally, there would have been a consultation process, or that would have been, if you look at how they did the ANTS reforms, the Australia's new tax system, led to the GST. I mean, there was a whole process beforehand where there was modelling, there was consultation, and John Howard took that to the election. So there's a lot of work done in advance, whereas this has just been announced. They would have had a small team in Treasury. They would have kept it hush-hush. And so they wouldn't have been having the consultations and that they should have to be able to get this right. And because they didn't announce it, that there wasn't a consultation process, you don't get all the people like Derek and all the other experts and Jeff Francis and Chris Joy, etc., and Jeff Wilson, who come out and say, look, there are so many problems with this. So in their defence, they wouldn't. I don't think they would have done it like this. It's.
Can I give the non-defence?
Okay, go ahead.
Treasury for about the last 10 years has been much more interested in hitting their woke diversity and equity targets rather than actually employing genuine economists. So most of the genuine economists have left. They haven't got any there. If they'd had anyone that had worked investing in markets, they would have immediately told them that this doesn't work. So what this tells me is that no one spotted the error in Treasury, and I spotted it within 2 days, not even having access to their model.
Yeah.
It tells me that they've got no one in there that has had practical experience working, investing in a stock market. And that tells me So that tells me that the whole pool in Treasury is just a ridiculous pool of useless people that don't know economics.
So does that mean?
But I think RW actually worked out what's actually going on here. And before we rip them too much, they've got a foolproof system of doing their modelling. It's based on cutting the head off a chicken and seeing where it falls in a solution square. So thank you, RW. Sorry, Gene, you were about to say.
I was just wondering, does this mean that we should have something like the US system where,
yes.
Where you have
regular alternation between private and public sector, so the people working in the public sector can work about the second, third, fourth round effects from any policy that they institute. It should be a rotational system, and if you've been 5 years in the government, you should have to be sort of automatically rotated out, and they should be paying salaries to attract good people from the private sector. You don't need many people in Treasury. You don't need 1,000 people in Treasury that all think the same. You need 5 or 10 really clever people that know what they're doing.
Well, I'm sticking to my story that Treasury's been all downhill since 2009 when Gene left. But Taylor has another suggestion here. Maybe it's the university's fault. Budget and modelling should be sounding the alarms on the quality of our econ and policy grads. Sausage factory of Keynesian economists without knowledge of cutting back once stabilised.
Look, I wouldn't expect a grad to pick this up, to be honest, because they haven't had experience in investing in stock markets over, say, 10 or 20 years. I picked it up immediately. The reason why is because I knew I was sitting on a lot of losses and I thought I could inflation index them and it'd be pretty good. And then I found out I couldn't. I was horrified. I thought, oh my God, this is a huge error that's going to lead to an economic calamity. Like for 2 or 3 days, I was basically paralyzed and couldn't do anything. It's someone with about 20 or 30 years experience and actually experienced investing markets. But also it's this non-argumentative culture they have. They have a sort of one team, one dream. If you're not singing from the Kool-Aid, which is this is what the treasurer wants us to do, we're going to help him do it, rather than pushing back and saying, well, no, here are the problems with it. There's not this argument. It's not the let's embrace the enemy. The enemy has an argument. Let's hear the enemy's argument. Do we understand the enemy's argument? It's not encouraging the proactive debate that's led to this huge error. So probably there were people that did understand the problem, but they were too afraid to speak out because they thought, well, I'm not going to get promoted if I speak out against it. And it's a problem of endemic culture. So my view is just anyone in senior in Treasury should be sacked by the incoming government. This mistake is so bad, and their continued cover up is really bad as well. The fact that they're not coming clean, and the fact that every time Treasurer Chalmers addresses Parliament, he is straight out lying, that is very bad on our democracy. It's a blight on our democracy, and it's a blight on Treasury that they're not coming clean on this.
So he's clearly dancing around the questions, but what's he lying on specifically, Derek?
Well, he said when asked, is there any country that has a tax rate higher than this, he said, I'm not going to give figures on real gains because real gains is inappropriate. And then he cites a figure on nominal gains, and his nominal gain figure on 21% is based on one share that always outperforms inflation, which is complete bullshit. No one invests that way.
Okay.
So, Gene, are you willing to take the role of Treasury Secretary after Prime Minister Derek sacks everyone?
Yeah, I'd take the job. Yeah, for sure. It's reasonably well paid, and I mean, you got that huge department that'll do all the work for you. So yeah, absolutely.
Well, no, I think you're required to cut the department back to 10 people. So Taylor's pushing back a little bit and just saying that they don't have confident and I guess competent grads coming out, pushing back against the senior bureaucrats. Well, I think there's a problem with universities, but that's going to take us at least another half hour to unpack properly. So let's just agree with that. And
the whole of the senior management of Treasury should be sacked because this is a giant stuff up and has real effects. It decreases our economy by 5 to 10%, and it's created huge investment uncertainty needlessly.
Well, just on that, Swordfish suggests here, chance of another Labor backflip. Look, we can only hope. The bad news here is the last set of backflips they did before the legislation passed. The legislation has now passed, right? So if they want to do another backflip, they're going to have to pass more legislation, which is going to be a bit harder to convince them to do. And they won't have the support of the Greens. If they try to do anything sensible, the Greens won't help them, obviously. Hopefully the opposition would. But it's, I'm not confident of that. Look, Anna came in, all guns blazing, I think had a few drinks and might have fallen asleep at the wheel. But she did write a few in here, so I think we have to face a few of them, Gene. Gene, why are you a communist? Why are you anti-human? She says here that liberalism is clearly anti-human. It gets me. And she got a bunch of other comments complaining, why do we keep defending this system of liberalism? Jean, do you want to defend
I'm not
liberalism?
sure what Anna means by liberalism, to be honest. I mean, are we talking liberalism as the Americans describe it, or are we talking the Liberal Party, or are we talking classical liberalism? I can't understand the question. So,
yeah, look, that was going to be my answer too. I think the word liberal is an overburdened word. There are some definitions of it which I still think are virtuous. There are some versions of it that I think she's kind of right. Has been a decaying force that has undermined Western civilization and led us down the wrong path. But without knowing which definition she's using, there's not much I can do with that. RW on ACT is dropping stamp duty and replacing it with land tax, right? So they're reforming their system.
That's a good reform. Tax. That's a very good reform.
Yeah.
If they do.
I think I've become indifferent to it. I'm not sure. Cam Murray has made the case, because pretty much every economist makes this case, and then it never gets done for political reasons. But he makes the case. This is just the timing of when you pay the tax. It matters kind of more what level you set the tax at.
No, not at all.
There could be you could set a stamp duty and an annual land tax so they had the same present value.
The problem with the stamp duty is it's a one-off tax when you move, so it inhibits the efficient moving of people between houses, locks them into their current house. So especially in places like Sydney and Melbourne, people don't move to near where their job is because the cost of stamp duty is so high. So you get huge congestion and other costs. If you have an annual land tax, you'll be indifferent. You'll just move to the house that's close to your work, and you'll move to the house also that's efficiently sized. It creates huge problems.
Yeah.
I guess the issue is
he's wrong there. I mean, totally wrong.
An annual land tax is far better.
He would only be correct if you could, if you had an assumption that people moved house a fixed number of times. Look, I got to say, I still push back a little bit, and this is my very unlibertarian, half thought through idea here. I'm not convinced that always decreasing transaction costs has ended up being good at creating a well-functioning, harmonious, cohesive society. I think reducing transaction costs was immensely a good thing when transaction costs were so prohibitively high, no one could leave their village. At this point, and this is a very kind of communitarian, conservative, unlibertarian opinion. I think the world might be a better place if more people live closer to where they grew up. But
John, it's an inefficient tax, even if we're just talking about moving in the same neighbourhood, right?
Yeah.
I mean, there's a dead weight loss, there's an excess burden. Just you can draw the supply demand diagram and look at the impact of the stamp duty. So it's clearly inefficient. So it's preventing
dead weight loss. So for people listening to that dead weight loss conversation earlier, it's worth unpacking. Dead weight loss means basically it comes down to, in real terms, creates a behavior that is undesirable. It incentivizes change in behavior away from the Pareto optimal or the set of behaviors that's going to maximize your expected lifetime utility. I'm making the case that I think people have been underestimating the utility value you get from staying in a place longer than you want to. It is a very unlibertarian argument, but it's...
you can still stay in your peri-urban, beautiful farm.
But they don't, right? When transaction costs come down, all of the young kids move to London and New Zealand.
Can I violently disagree with you, John? Because I think children, when they first leave home, they typically get a job away from the parents. They get the job wherever it best is, and quite often that's significant way. If they buy a house there, then they're sort of locked into that. So the chance of moving back to near where their parents is low. If they face the zero transaction costs later on in life when they're having children, they'll probably move back closer to the parents because the parents can be for free.
That is an excellent point. That's an excellent point. You didn't know about my follow-up policy on that, and that is no stamp duty if you buy within X minutes drive of the rest of your family. Anyway, we already asked this. Where would you put your money? You said into super funds. I've
got a few other things as well. So super funds, definitely, if you've got your house paid off, no direct self-managed super fund for the wife, and then children, once they're over 18, set up self-managed super funds for them. That way you pay 10 to 15% tax versus this, which is about 60 to 70%. For young people, I haven't yet figured out a way to avoid it other than moving overseas.
Again, moving away from your family. So this is a follow-on from the land tax one. Taylor is agreeing that we have a bunch of Georgists amongst us. The Georgists are walking amongst us. The land tax
Well,
is one
even
of
the
the most
neoclassicals say that.
Yeah.
Yes.
That's not just a Georgist.
It's equitable and efficient.
Yeah.
Now, it is true that the behavioural response is lower. There are some people who make the exaggerated claim that there's no behavioural response. Of course, there can still be behavioural response because it changes the incentives of the mix of land, labour and capital you put into producing something, and it is possible to trade those off. But yes, the behavioural response tends to be lower. So
and it should be, I'll do a subtlety on this for those that are really economic down. It should be based on the capital improved value of the land, not just the land value. And that's much more efficient way of funding public goods. And if anyone wants the proof for that, they should read the 2017 IPART report on efficient council bases, which I had a hand in writing.
Okay, I'll have a read of that because intuitively I would disagree with you.
Intuitively disagree, but it's wrong.
Is to say,
it gets you much closer. It gets you much closer to the Lindale solution for the efficient funding of public goods.
Okay,
That's
okay.
So in other words, if you're living close to a train station, the 1,000-block apartment pays the same rates as the mansion next door, which isn't highly efficient in terms of funding local public goods. Yeah, have a read of it. It's good paper.
I will. Okay.
You also mentioned what Adam Smith would say on this. He was against the idea of income taxes. He was against general consumption taxes, but he wanted sin taxes against bad things, and then land taxes. Right, so that's also where he landed at the time. Sin taxes and land taxes. No tariffs or income taxes. All right, what's the next one up here? I have no idea what this is going to say. Constitutional change that a budget has to be balanced to zero. I would say balanced to plus or minus 0.5% or something like that. Otherwise, it's going to get kind of awkward getting to exactly zero. But yes, your general point, or maybe it has to be within X amount of time. But yeah, look, I'm sympathetic to this idea. I think if you could trust politicians to act in the interest of the public, then this would be suboptimal because you want to have their leeway to be able to adjust the circumstances. And I think every politics degree, you open up those textbooks, it's all based on the idea that politicians are just wise and benevolent. And sure, if you make that assumption, you get one series of policy recommendations. I believe that public choice theory is correct. Public choice theory economics, where you treat politicians not like angels, but like humans who are also trying to utility maximize. That makes them imperfect. And once you factor in imperfect politicians, sometimes you need rules that are themselves imperfect, but they prevent politicians from doing stuff that I think is going to screw things up even worse. So I'm sympathetic to this rule, noting that if you make the people who study political science, they're all communists, the people who study political science, if you make their assumption of wise politicians, this would be a suboptimal policy. And I admit that. I still think it's a good policy. Thoughts, gents?
I agree with you. You could have just been, you were channeling James Buchanan and Gordon Tullock there. I thought that was brilliant, John. I loved it.
Oh, they're great economists.
Look, I think you need a bit of flexibility. I'd prefer a sort of parameter thing because, look, if unemployment's high and other sorts of things because of economic shocks, you might go into a bit of deficit sometimes, and other times you run a bit of a surplus as well. But you'd probably want some sort of rules. Look, over a 10-year period, you have to basically create an average. But if you have this, you've got to be zero over a year. I think it would lead to a little bit of a handbrake that's inefficient. But look, the other thing that's more important is just correct accounting for what I call the off-balance sheet items. We don't even know what a balanced budget is anymore. You've got things like the NBN that they've sunk 60 or 70 billion into that's not going to earn any return on capital. And they haven't costed us 1 cent. And Snowy Hydro is another one. It's $40 billion. It's not going to return anything to the community. So I'd start with the low-hanging fruit, which is no more off-balance sheet funding, so we can at least know what the true state of the budget is and know how unbalanced it actually is. Then go for the bigger picture reforms.
Yes, it's another common theme that we've come back to on this show many times. The off-budget shenanigans with the non-financial public corporations is normally where they're doing. Although there's plenty of financial public corporations that are getting up to shenanigans too.
Yeah.
Back on the beers. Yes, I've run out of whiskey, so I'm just starting with the beers today. But those are my two drinks of choice. Normally it's whiskey in winter, beers in summer. But if there's no whiskey, then this is just non-distilled whiskey, right? Whiskey is just distilled beer, so it's still the same thing. Then you've already answered this one. Off the book accounting. Yeah, I had this so that we could rant about off the book accounting, but we've already done that rant, so I'll keep it going.
That's that's relevant to my comment about the Hobart Stadium. So
yes, as well. Yes,
yeah.
Absolutely. A wonderful quote from Kerry Packer here is that tax minimization. Of course, I'm minimizing my tax. And if you're not, then you need to get your head read. The government's not spending the money so well that you should be donating extra. That's if you haven't seen that before, go put that into YouTube. Google it, Kerry Packer evidence to Parliament or something like that. It is a glorious clip. Some people disagreeing with the order. They said that Victoria should be last. Look, I think Derek made a good point that if you were doing, say, over the last 10 years, but I was trying to critique this budget, right? So if we came in, if the three of us came in as the triumvirate running Victoria tomorrow, and we reformed the budget, I hope you would see that it was a good reformist budget, and you wouldn't say, oh, but taking the last 10 years together, we still suck, right? We can't change history. We can only change what's going forward. And based on what's going forward, South Australia is increasing spending quicker than Victoria is. So shame on you, South Australia. Some people talking about Joyce when we were talking about him. He's an accountant.
Sorry, just the quality of the spending in Victoria, though. It's not just what they're spending; it's the quality of it. It's atrocious. Like they're doing these things like free fishing rods for children and stuff like that. It's insane. The whole thing's insane policy and that they're spending on.
Well, I would prefer that because free fishing rods to children would have very few behavioural changes, I think. There's probably not going to be that many people take up fishing because of it. In Queensland, we've got 50-cent fares on public transport.
But they've got that as well. Yeah.
50 cents, okay.
No, they've got the free public transport stuff on weekends and all this other crap. They're all just the same. Yeah, they're not as bad as 50-cent fares, but anyway, yeah, don't get me started.
So I mentioned Adam Smith before. We've got another reference to Adam Smith here from Taylor. Government only needs to fund judicial system and defence. Wasn't that Adam Smith's position? Not quite. He also added some public works. And he added upholding the honour of the royal family, which is probably not that relevant to us these days. But, just to be complete, he did say some public works, by which it seemed he meant some public goods, which a lot of people would agree with because they're public goods. But it seemed he defined some public works a bit more broadly than public goods. To be fair, he didn't have a proper theory of what public goods were at the time. So he was working without an economics textbook since he was the world's first economist. But yes, defense, judiciary, some public works, and upholding the honor of the royal family. And he did sneakily talk about later that some sin taxes. So I guess that's not a spending, but that's a attempted behavior.
Externality arguments for him to mention. Yeah.
Which I think he's wrong about. But, he was operating 250 years ago. This is the 250-year anniversary of Adam Smith's Wealth of Nations, the book that many say launched the field of economics. And 250 years. I'm going to just give a plug there, by the way. The Campion College, which is a small niche liberal arts university. Liberal arts not in the swear word sense, right? As in well-rounded education, not being woke. It's a small university based out of Sydney. They're putting on a conference, the Adam Smith Conference, to celebrate 250 years since the production of The Wealth of Nations. Got a bunch of interesting speakers there. Of course, I would say that. I'm one of them. But we've got, John Ruddick, Chris Rath, Chris Berg, a few other good people, the great and the good of the free market friendly types, where I promise not to bring up my ideas about stamp duty. Is that my heretical ideas? But yes, go and check that out. Go and have a look. Campion College, Adam Smith Conference. It's coming up, I believe, in August. So if you are in Sydney or near Sydney, see if you can get along to have a look at that. So thank you, Taylor, for letting me get in that plug for the Adam Smith Conference. Now, we've had a bunch of comments come in here, but I think we are hitting up to 2 hours and 10 minutes. I was going to try and keep these under 2 hours. I have failed yet again. So unless there is a comment, Gene, that you can see in here, that is...
I like...
free fishing rods could be machetes.
And don't talk about the $10 million bids, the machete bids. Yeah, I mean, just madness down there in Victoria.
Anyway, I think they're going to wrap that up. So thank you, everyone who's been joining us for this live, and thank you for the people who are watching later. Gene, we normally wrap this up by me asking you guys. So, Derek, I'll ask you this in a second, but I'll ask Gene first so that you've got a moment to think about it. But, Gene, what have you taken away from this chat? What is interesting or worthy of remembering?
I'm going to think more about Derek's his justification for income splitting. I thought that was a really, that's worth thinking about, that Pareto optimality argument, or the family, all members of the family facing the same marginal tax rate. I thought that was a really interesting way to think about it. So I thought that was, I'll reflect a bit more on that. John, what about you?
I like the general chat that Derek was leading about this problem with the capital gains tax. This problem that hasn't been properly thought through, and allowing that issue to be ventilated more thoroughly. I think if more people are aware of these sort of issues, perhaps we're going to get a bit more pushback and we might get the political response. So we're doing our own small part towards that here. Derek's been fighting the good fight. If you haven't seen, he was on Karl Stefanovic's podcast a couple of times, at least one time, talking about this issue. I haven't watched the second one yet, Derek. Apologies. So go check that one out as well. We're sending you to the competition. But I think that's an issue that needs to be better understood. Derek, have you taken away anything from this chat that's worth commenting on or remembering?
Yeah, look, I just wonder if I can give one quick. I'm on Decker as well. All of my analysis is Decker on X. I've posted all. I've made it all publicly available, all this capital gains tax. So I personally welcome debate. If anyone can find any flaws in what I've said or any improvements, I'm happy to listen, and I try and respond to everyone. So just feel free to follow me on X under Decker. And many hands make light work in this. The greatest journeys in terms of reform all begin with one small step. So I'd encourage everyone who's interested in trying to make Australia a better place to actively get involved in the debate. Look, what I've worked out, John and Gene, is I've not met either of you two before. I recognise you're two very bright economists. I've really enjoyed the chat. I've enjoyed engaging with the audience. So I'm very thankful for having the opportunity to share my views on this chat, and happy to, if I can add value again on anything, I'm more than happy to come on again. And hopefully together the people that are economically minded can change the world.
I'll just quickly put up there the how you can find Derek on the Twitter. He has not yet given himself a good handle. Derek, you still have time. You can go and change that handle to get rid of all those numbers, unless 90653 means something to you. But currently, if you want to find him, Derek Frank, a Frenchman, 90653 on the Twitter. So go and plug that into Twitter now. Go and find him, give him a follow, and check out what he's been saying. Otherwise, if you're following us on the Australian Taxpayers Alliance or myself, I'll write something up after this that links you to Derek as well, so that you'll be able to find him that way. So with that said, thank you, gentlemen, very much. Thank you for the people who came and listened. This has been hosted by the Australian Taxpayers Alliance, taxpayers.org.au, and Oz Taxpayers, AUS taxpayers.substack.com. Please go and check out what we're doing. Sign up to the newsletter. If you like what we're doing, please consider becoming a member. A couple of dollars a month keeps things ticking over. Of course, if you're rich, please give a hell of a lot more, but a couple of dollars a month help things ticking over here. So please consider doing that. We do this live stream every Thursday night during winter at 8 p.m. So if you've liked what you've heard, please come and join us again next week. We've got I know who the guest is next week, but I'm not going to say it. So you have to leave you on tenterhooks. Wait for the announcement next week. We've got some good guests coming up, though, in the coming weeks. So we look forward to seeing you then. But until next week, everyone, stay happy and stay free.